Hello there. Can
Good morning.
anybody?
Good morning, Mark. We can hear you.
Wow, a miracle. I got in. This has been a 15-minute exercise.
Best way to get the metabolism going in the morning.
No, 2 cups of coffee have really done it. I'm buzzing right now.
Good morning, good evening, and good afternoon, wherever you are. Thank you for joining us. Distinguished speakers and participants, welcome to this webinar on the COVID-19 impact on transfer pricing. As you all know, the pandemic with its health and socioeconomic impacts is a crisis of unprecedented proportions. It has disrupted almost every aspect of our lives. This also includes disruption of business supply chains and operations. As a consequence, businesses have had to adjust their operations to deal with the consequences of the pandemic. This has led inevitably to changes in their transfer pricing positions and posed related challenges for tax administrations. Building capacity to conduct transfer pricing analysis in these challenging times is crucial for countries' efforts to mobilize resources to finance response to the pandemic and lay the foundation for sustainable recovery.
Yeah.
This UN webinar is designed to help governments to deal with these issues. The webinar engages policymakers, tax administrators, civil society, and other stakeholders on the transfer pricing challenges posed by the COVID-19 pandemic. We are going to pay special attention to 3 sets of issues. First, transfer pricing challenges of the COVID-19 pandemic. How are extraordinary losses and gains to be attributed? Extraordinary gains, or in many cases, losses, need to be properly attributed to entities according to their functional and risk profiles. The existing transfer pricing policies will be affected by an economic downturn, meaning the transfer pricing models may need to be adjusted. In addition, Businesses need to ensure that their transfer pricing policies take into account any government aid received to mitigate the impact of the crisis. Second issue, comparability analysis in times of economic downturn. Transfer pricing analysis has often proved challenging for many developing countries, given the lack of reliable local comparables. COVID-19 has accentuated this challenge. The fundamentals of comparability still apply, however, and we will hear about the continuing relevance of the UN Practical Manual on Transfer Pricing for Developing Countries and OECD guidance on the arm's length principles in good and bad times. Functional analysis will also be affected by the remote working arrangements. They change the staffing component, and by funding and financing arrangements, which may have changed considerably through restructuring to assure liquidity, repricing of interest rates, or lowering of the rates and deferral of the repayments. Third, dispute avoidance and resolution mechanism. In these unprecedented times, disputes are even more likely to arise. It is important to focus on avoiding and resolving these disputes in order to minimize double taxation. The effective use of advanced pricing agreements and mutual agreement procedures, as well as other mechanisms to promote tax certainty, will be central to managing the uncertainty caused by the pandemic. Ladies and gentlemen, we are privileged to have renowned experts in international taxation from different backgrounds, representatives of international organizations, government, civil society, the private sector, and academia as our panelists in this webinar. These also include some members of the UN Committee of Experts on International Cooperation in Tax Matters. And of course, its multidisciplinary subcommittee on updating the UN Manual on Transfer Pricing. We look forward to open and engaging interaction among experts and participants. But we are also keen to get your feedback and suggestions on how DASA can help you in your efforts to find solutions to tax and transfer pricing challenges in the coming months. And the best way to do is to complete the short survey immediately after the conclusion of the webinar. Finally, I would like to thank the Norwegian Agency for Development Cooperation, NORAD, for its support. This webinar comes to you as part of a UN DESA multi-donor project to strengthen support to the UN Tax Committee, its subcommittees, and of course, its related capacity development work. The goal is to ensure that international cooperation, policy, and practical guidance on tax matters increasingly reflect and respond to the needs of developing countries, particularly during these testing times. Once again, thank you for your participation, and thanks to the experts to serve as panelists. And I wish you a fruitful and productive webinar. Thank you.
Thank you, everybody. I'm Michael Leonard. I'm the Chief of International Tax Cooperation section of the Financing for Sustainable Development Office. And like Naveed, I welcome you to this event. We've got over 580 registrations at the moment, and about 50% are from government, so we're very happy with that. The event, for a bit of housekeeping before we move to the speakers, the event will be held in English only. We haven't been able to achieve translation for this webinar, hopefully for some future ones. Participants have received the agenda, so you have speaker bios, so the presentations of speakers will be very short, and you have the slides. Your screen name should show your name and the country or the organisation you represent. If that's not the case, if you ask a question, if you can make clear your name and affiliation would be useful. You can ask questions using the Q&A function at the bottom of your screen, and please keep those questions concise. If we don't answer during the particular sessions, there will be an opportunity to answer those questions in the fourth session of the day. So make sure you stay to that. It's an important session, and it's important from us. We learn from the questions as much as you might learn from the answers. So the webinar has 4 sessions. The first will set the scene, session 1, and we'll talk about the issue of extraordinary gains or losses and pandemic costs. Session 2 will focus on the issue of comparability analysis and government assistance as one of the issues that is discussed there, the impact of government assistance on transfer pricing analysis. Section 3 will conclude with a discussion on how the pandemic has affected dispute avoidance and resolution mechanisms. And finally, session 4 will be dedicated to the Q&As, as I've mentioned. The coffee break will be from 10:15 a.m. to 10:25 a.m. New York time. And we hope that you enjoy the event and learn a lot from it. We're certainly very fortunate with the speakers who have agreed to attend, and there are a lot of people behind the scenes who have been very helpful in organising this. We'll mention them at the end of the day. So I will now move to session 1, and what I'll do is give a very brief introduction, as I mentioned, to the speakers. We have a great combination of experts to speak on this issue. First of all, we will have Mark Levy. He's a senior counsel in the New York offices of Baker and McKenzie. He's had over 30 years of experience in international taxation, and he also teaches at New York University. Many of you also will have some of his excellent books on transfer pricing on your bookshelves. Carlos Perez Gomez Serrano, who served as the head of the transfer pricing taxation at the Mexican Central Tax Administration. He's also participated as a delegate of the OECD's Working Party number 6 on transfer pricing. And he's a member of the UN Transfer Pricing Subcommittee, which has produced the UN Transfer Pricing Manual. He's now with MAAT Assessores and is a continent leader for Royalty Range Latin America, an important database. Yan Jiang is the Deputy Director of China's State Administration of Taxation. She's been working on a rotation basis for 1 year as a top management official in China's largest field tax office, the Pudong District Tax Office in Shanghai. So she has a lot of on-the-ground experience of transfer pricing. She's also a member of the UN Tax Committee. And finally, Tove Maria Riding is leading the tax justice team in the European Network on Debt and Development, which is Eurodad. That's a network of 59 non-governmental organisations from 28 European countries working on issues related to development finance. Tove has had a long and very distinguished role in helping us in the UN and elsewhere focus on tax justice and the role of tax in sustainable development. So I will now pass to Mark to present on this issue. Thank you, Mark.
Mark, you're muted.
Michael, I'll have to repeat this. I didn't realize I was muted. Thank you so much for the kind introductions. And again, I'm privileged to be on a panel with such distinguished people that you've just introduced, as well as part of this wonderful webinar. The topic today, and you can see on the slides, there are 5 topics we're going to cover. Some of these topics will be discussed later on in the program, so we're not going to go into great detail on them, but try to hit the high points. Comparability, allocation of losses, changes in the supply chain, government assistance, and advanced pricing agreements. And comparability gives rise to probably one of the most difficult issues that practitioners have to deal with, since practitioners so much rely on the data that's provided in the various databases to benchmark their intercompany transactions and looking at third parties. Now, we know that data is not always perfect, but it is publicly available data, and it is used not only by practitioners, but so readily used by taxing authorities. And probably the most prominent methodology that is followed is in the United States, the comparable profits method, and abroad, the transactional net margin method. Now, some of the problems that really exist in comparability is the data generally lags a year behind on the for the taxable year that you're trying to benchmark, and as a result, it's going to be difficult to pick up some of the impact of COVID when we're looking at data from 2019, where for 2020 and for 2021, when we're looking at data for 2020, because of the fractional parts of the year that were impacted by COVID. The other thing is that when you use these particular methods, you're looking at companies that are not necessarily in the same industry, but companies that are functionally equivalent to the company that's being the tested party. And that gives rise to potentially a number of different companies in different industries that may make up your comparable company sample. And the fact is that those companies may be variously affected by COVID-19. Some, as we know, there's been winners and losers during COVID-19. The big winners, of course, have been the big companies like Amazon and Google and online distribution. The big losers have been retail, where there's been a lot of store closings and a lot of department store bankruptcies. So when you have a mixture of these functionally equivalent companies in your comparable sample, it becomes very difficult to be able to utilize those in an effective way. And you're now starting to see companies look to their own internal data, their own budgeted financials, to try to create trends for purposes of comparability, but more important, trends for how to make potential adjustments. And that's where in COVID-19, the imagination and creativity comes into place here, because you might try to make adjustments to the financial statements of the tested party to align them with your comparables to show what would have happened had COVID not taken place. Similarly, you might make adjustments to your comparable company sample, their financial statements, to the extent that the data is more robust, to be able to show how they would have fared out compared to the tested party had COVID not taken place. And these adjustments, are fact-based. They can be done. They can be done creatively, but they're not going to give the level of certainty, and particularly if you're under audit, that taxing authorities are going to all agree upon. So what we may be walking into is going to be a very, very difficult scenario of potential disputes. And the disputes get even more, contentious, excuse me, when you get into a mutual agreement procedure and you have the different countries looking at these adjustments in independent ways and not necessarily buying into the methodologies that were used for these adjustments. But that's all that's really allowed. You may get lucky in your comparable data and find companies that have incurred similar losses to the tested party, and that could be useful. But that's not always going to be available because not all the databases are as robust as we would like them to be, particularly when you get outside the United States. The reporting becomes a little bit more sketchy. So comparability is going to be a real challenge in being able to conduct the benchmarking the way one would like to do it in a traditional non-COVID arena. The big issue, of course, is going to be, and Michael, if you wouldn't mind moving up to the next slide, is going to be in the allocation of losses in pandemic costs. I mean, it doesn't take a rocket scientist to understand that there have been a lot of companies that have lost a lot of money, and their costs, and particularly their cost ratio to gross receipts, have changed significantly because of the adjustments that they've had to make business-wise to be able to deal with COVID. And the question becomes how to allocate these profit and losses based upon shared risks. And that last statement is a loaded question. What are shared risks? Who's bearing those risks? We're not in a traditional environment now where we have a kind of a master-servant arrangement between a parent and a limited risk distributor. We're in an environment where even the limited risk distributors are not able to make profit, and all the profit shouldn't be pushed back, or losses pushed back to the parent. And if you have distributors that are full-fledged distributors, meaning these are distributors that are helping build the market and have potential marketing intangibles, those and they have market risks, those risks are going to be very, very difficult to quantify. And again, that takes you into a little bit of never land, because there's no magical formula for how to do that. You try to do the best you can on a fact-based scenario. But again, when you get into MAP and or even just routine audits, you could get 3 examiners and have 4 different opinions on how this should be done, and it's going to be difficult. Probably one of the more interesting issues is how to determine whether you've got exceptional non-reoccurring operating costs. And remember, from a transfer pricing point of view, we look at operating margin. Exceptional costs tend to fall below operating margin. Accounting standards have very different definitions for what are extraordinary costs. And of course, in the COVID-19 environment, extraordinary costs may be stretched quite a bit. But to the extent that you can go through the financial statement and identify these extraordinary costs and list them below operating margin for this period, that may help in how you go about determining whether you're lining up with your comparables. But again, defining those extraordinary costs, even those non-operating costs, is going to be very, very difficult. And of course, you also look at the legal agreements. In legal agreements, you want to look at a force majeure clause. Is it by the act of God? Well, COVID-19 is certainly, as a pandemic, by the act of God. And to what extent have they been burdened by these provisions, and trying to determine, how that impacts your allocation of losses, or your losses in and of itself, is going to be a very, very difficult exercise. Getting to risks is really going to be the challenge here. And who's bearing the marketplace risk? Even the limited risk distributor has certain marketplace risk. But what happens if you have a full-fledged distributor who is helping build your brand in that foreign jurisdiction, and it owns, it's a beneficial owner of the marketing intangibles because it's brand building in that jurisdiction? Now you've got a real shared risk, but how do you quantify that shared risk? Not an easy question whatsoever. And as we get into later on and we start talking about digital economies, determining where that marketing intangible market risk may lie is going to be a very difficult exercise, no matter how you go about computing your profit for a digital economy. Operational risk, there are just things that are happening, and we'll talk in a little more detail about disruption in the supply chain, disruption with logistics, store closures, and to what extent that is causing. I mean, anybody who's purchased anything online has found out that it's taking longer to get from the factories to the consumer simply because of these disruptions. How does that impact your risk, and who's bearing that risk in the marketplace? Financial risks, obviously, borrowing costs, defaults, delayed payments. These are extraordinary times, and depending upon the quantum of those financial risks, this may also fall under exceptional non-reoccurring operating costs or extraordinary costs, and it's something one has to take a look at. Tariffs. Tariffs is a very, very interesting issue. We all know that tariffs fall on the consumer, but they also can affect significantly the company's margins. If the tariffs are going to raise the price, you may find a lot of companies are going to have to eat that cost because they don't want to lose their market share against competitors that may not necessarily have the same level of tariffs that they may be bearing, depending upon the country or origin of where their products are coming from. This happens frequently. In how do you quantify where you're burying your tariff costs instead of passing them on to the consumer because you're trying to preserve your market share? This is it can be a very significant issue for companies, and indeed, not one that they pay much attention to. But again, it depends, because where the products are coming from, in what jurisdiction the products are coming from, and are they coming from a jurisdiction where there have been significant tariffs versus coming from a jurisdiction where they're not, and that's something we have to certainly look at closely. Michael, next slide, if you can, please. We talked about, and I talked about the supply chain, and supply chain is very much impacted by digital economy. So this is the one place I would like to mention this. There are various different views around the world on how to deal with digital economy. In the United States, they look at digital economy as they look at any other distributing operation. They don't have a specific approach. You have countries like India, for example, that determine that wherever the customer is, that's where the profit should lie. You have countries like France and Kenya, which have special digital taxes, excise taxes. You have certain economies that are taking a look at the prescribed amount allocated for marketing intangibles. Nigeria, for example, and Michael may talk about this later, has a substantial economic presence test. There's some thought to modifying the permanent establishment definition in treaties, which from a US point of view could be very difficult, because unlike parliamentary countries where they can make changes in their treaties within 60 days. We have treaties sitting 8-9 years that haven't been approved by Congress yet. So it's just it becomes difficult. And then you have the OECD, and the OECD has come down with their Pillar 1 and Pillar 2, and it's an effort. Pillar 1 and Pillar 2. Pillar 1 is what I really want to talk about. It's an effort to get some certainty, but it's the devil's in the details when you look at what they're trying to accomplish. It does not have the simplified approach that the United Nations has taken, but they break down Pillar 1 into amounts A and amounts B. Amount A looks at consumer-facing businesses. I call it the app approach, where you try to determine the total profit before tax. And here you're looking at a consolidated profit and trying to allocate a fixed percentage of routine profit to the owner, call it, of the app. And then you take the residual profit that's above that deemed routine profit, and you start to allocate that to the market jurisdictions. And how you allocate that would have to be on some objective standard. It could be on sales, it could be on some other criteria, but it's drawn a lot of criticism for a number of reasons, one of which is doesn't necessarily follow the arm's length principle, and number two, while it gives companies certainty, it hurts a lot of those companies that have produced the product, developed the marketing and branding for that product, and they're not necessarily getting a return commensurate with the investment that they've made. I know, Jan, I know you can't talk about what SAT is doing, but you've been involved in this, and you may have some, 30,000 foot views that you might like to share with us on this before we move on.
Thank you, Mark. You're right that I think this may not be the most appropriate place for me to present China's country position to Pillar 1 or my personal views on the specifics of the IF solution. So just a very brief description of what's been going on at the IF. We had the latest SG meeting early this March when the US new delegate made his debut. And at the meeting, all delegates have expressed a strong desire to reach consensus by mid this year. And there were also discussions on how to view and treat the various domestic measures you have just mentioned countries are currently taking on digital. At the end of the meeting, Pascal asked delegates to be prepared for discussions between now and June on a 7-24 basis. So we can see that the determination is really very strong there. But having said that, I think there are still some very difficult balances to find before a consensus could be reached. Everyone shall be ready to make some compromise because this is a consensus-based mechanism, as we are all aware. Well, as a UN committee member, I think I couldn't touch upon this topic without also mentioning that the UN Tax Committee has been devoting a lot of effort trying to find a solution to the digital challenges also. Back to you, Mark.
Thank you, Jan. And the UN has put a lot of pressure on the OECD because the UN approach is a much more simplified approach. It's dealing with developing countries that don't have the wherewithal, the resources to be able to go through the exercise that the OECD has suggested. So I think there is some pressure put on Pascal Salaman and the OECD crew to come up with something a little bit more simplified, yet provide the certainty that the business community would really want. As we go through just looking at supply chains, again, excise taxes, value-added taxes, tariffs, modified pricing issues that are being used by taxing authorities to try to deal with all the issues within this in the supply chain. But again, where the supply chains have been disrupted has been slowness on sourcing, slowness on procurement, production layoffs, manufacturing slowdowns, logistics, and again, tariffs that I had mentioned before. And this all translates into additional costs and problems and risks, you know, for the companies that are providing the goods. And how do you address that in a transfer pricing way? It's not so easy. Michael, can we just move on to the next one, because given the time, I want to run through these fairly quickly. Government assistance is a very interesting issue. You're seeing that just recently the U.S. Brought in this, promulgated this assistance program to $1.9 trillion. It's scattered over a number of different needs, some of which is going to middle market companies that have been so significantly impacted by the pandemic. What do these levels of assistance create adjustments from a transfer pricing point of view? Do these programs mitigate risk for the particular taxpayer? Sure, certainly, I think it mitigates the risk, but whose risk? And how are transfer pricing adjustments made? The one thing that we know that's clear, and CRA came up with an announcement not too long ago that essentially says that all this has to be included in taxable income. It's so that if you get an assistance and for example, it's helping you reduce your costs, you still have to take into income the assistance that you're receiving. You can't put that assistance in your cost of goods sold. And I think that's the same position that we're seeing in the United States. It's still taxable. There's no tax-free ride on the government assistance. So that's something that we need to take a look at. And again, as you start going through your transfer pricing analysis, you look at your comparables, you look at your risks. Government assistance, in many regards, mitigates the risk, but you have to determine who's getting the benefit of that risk, which company within the supply chain. I'm running short on time, and I want to save time for my panel, so I'm going to just mention advanced pricing agreements very briefly. You have John Hughes speaking later in the panel from the US APA team, and I know he will cover this. But we're seeing that many of the APA teams, I know the US, Canada, Germany in particular, that I've been dealing with lately, have COVID committees. They're focusing on the precise issues for the taxpayers, trying to provide specific relief in the APA program, which is why you're seeing so many people go into the APA program. One case where I was involved, instead of taking a set price, we took a range, and we were allowed during the COVID period to hit the low end of the range. This particular company was hurt, but it wasn't, devastated by the pandemic. So hitting the lower end of the range was a relief. But again, they're looking for creative approaches, and some of the creative approaches can be in how you deal with the extraordinary costs and how you can list those below operating profit and show that you're still trying to achieve an arm's length amount, and had the pandemic not occurred, these adjustments show that the pandemic was more the cause of the issue rather than transfer pricing, which always seems to be a suspect when there are losses. And I think with that, I'd like to get more input from the panel. And maybe this is a good time to, Michael, start off with our panel and get some of their reactions to the things that we've talked about.
Thank you, Mike. I think we'll pass to Carlos first of all for some comments. Thank you, Carlos.
Yeah, thank you very much for the invitation, for this opportunity, and taking from my previous experience as a tax official and as my actual role in the private sector. First of all, before beginning, I just want to react really quick to Mark's comments, because in our prep for this call, it was interesting to see how some entities were described as low-risk entities, like for example, like this is a perfect example, the maquiladora sector in Mexico. So what I want to pose here is just a reaction where the maquiladora industry in Mexico how is seen as a low-risk activity, and how this has interacted with COVID-19, the crisis. And even if we can accommodate some negative effects through conventional mechanisms of measuring profits in the maquila industry, safe harbor or not, through the capacity utilization adjustment of operating assets, it would be necessary to clarify that a riskless entity does not exist. And this is clear from the OECD document as well. And in the particular case, in the case of an unfulfilled agreements between a maquila company and its principal company, it would be necessary to resolve which party would assume the costs of items not being produced when the plants were shut down. And I just want to ask if you have something in mind to the panel, because I think now again, the definition of a low-risk entity or a no-risk entity is no longer viable.
Carlos, I just want to make a quick comment. I don't think the maquiladoras are any different than any other contract manufacturers. They're suffering from worker layoffs. They're suffering from procurement. They're suffering from logistics. This all impacts their responsibility in getting the product to, out of the manufacturing facility, and ultimately, assisting to getting it to the customer. So I agree with you that it would be difficult to say that maquilas are no risks. They do bear that risk in the supply chain.
Yeah, I just think that maybe it's healthy just to see that these companies would not be put off from any COVID-19 effects, because there are any defined low-risk entity, it should be allowed to make an analysis of the COVID-19 effects, because every company has effects or had effects on the COVID-19 phenomenon. So I just wanted to make this clear, because I think in developing countries, it is normal to have the vast amount of low-risk entities, which give a sense that they should not have negative impacts from anything in particular. So I think it's more about going back to the basics on what we discussed on BEPS, and really make a good exercise on profiling the companies, the risk profile, the function profile of the entities, and see how the risk would be shared between the entities.
Yeah, I think, Carlos, your functional analysis that you has to take on a creative approach. It can't be just the standard functional analysis you would normally see, because you have to identify those risks and those events that have really impacted you.
Unfortunately, as you may know, I mean, information is really scarce. So even though there should be companies like that working on an isolated basis, we don't have information. So as I would agree to you that we need to be more creative on see how they would be impacted by the market with this profile. And now, I just want to favor everything you said, Mark. The transfer pricing administration post-BEPS, that it was a difficult phase, has amounted more complexity as we were hit by the COVID-19 crisis, since I believe business outcomes and realities has dispersed. So there's much more dispersion and variance on the results of the companies. As the application of the transfer pricing methodologies, I believe is an exercise of contrast, of far from perfection options. What I say is that the best method rule, sometimes it becomes really difficult to see which is the best options, because sometimes you have some so many imperfect options that you really need to choose the last worst result and not the best one, because and this exercise of contrast becomes really difficult. So now with the pandemic, it would be more important to rely on corroborative analysis or sanity checks to understand the economic landscape and the specifics of the business, including, and this is really important issue as well, the consolidated financials of the group. So I think the first issue here is that the sanity check that is not obliged for taxpayers. Now it comes handy, and companies and tax administration should see this corroborative analysis as something that would favor a best result given the subjectivity and the lack of information. And the second one, and as you refer, Mark, the projections of the same company's internal numbers and the consolidated financials of the group can also be a reference. So I think we have to think about how we may use this information just as a reference on how COVID-19 impact the specific multinational group. This situation of impacts and lack of information is exacerbated in developing countries, of course, because of the same problem as I referred of the lack of domestic information. So a relevant element will be the comparability of government aids, government assistance. This is something really difficult because you may note that several countries did not give a relevant support to taxpayers. So I believe that there should be much more guidance from tax administration on how we may perform these adjustments. As Mark referred before, these assistance are taken into account by different governments in a really specific way.
You know, I'm glad you're mentioning that, Carlos. And I just to jump in, because I didn't really define modified transfer pricing. That was in the slide, and I saw one of the attendees ask that question. But you eloquently provided all the criteria that's now being used in modified transfer pricing to work with the best you can in order to be able to show an arm's length result. And it's all in those adjustments that are necessary because of COVID.
Yeah, Mark, that's the issue there. So tax authorities will be better off waiting until contemporaneous information is available and they be capable of measuring and adjust with more certainty the possible impact of the crisis. And I saw a comment just referring waiting until the end of 2021 for results to be there of the crisis of the comparables. So I would agree to that comment. And so non-recurring expenses that you refer, Mark, not only from the tested party, but also from the potential comparables, have to be measured along with the contemporaneous data to come with a more accurate result. Also, it would be beneficial and realistic that the tax administration would permit and provide confidence on transfer pricing adjustments once they have reliable information for their intercompany transactions, even after the annual tax return that would normally be in the following months after the end of the year. Technological means as well can facilitate how taxpayers file their intercompany transactions. They file observation and risk transactions, such as intangible related transactions and restructuring, as well as motivate tax administrations to provide clarifications on the definitions of the comparable search criteria. If they should avoid losing company or not, as well as the significant risks and how do you define them. And also, I think not least, HTBI, I think is something that would come more in a discussion. So I think guidance is really important for governments to provide in a really opportune and prompt way. And finally, just a quick comment on APAs as a possible way forward can be to permit, and this was discussed before with our panelists in the preparation for this, to permit taxpayers to adopt the IQR range and not only a fixed percentage when they agree in APAs, in exchange of transparency from the taxpayers on its transfer pricing policy to establish its prices ex ante. So the transparency would be also a key element and a value. So I wanted to be really quick because I know there's more panelists, Jan and Toby. So I would open the floor for them. Thank you very much.
Thank you, Carlos.
Thank you, Carlos. So we'll pass to Jan for any comments from your side, Jan.
Thank you, Michael. Thanks to the UN for inviting me, and thanks to Michael for that very kind introduction, but maybe a very gentle clarification here. I came to the field office only very recently, and actually most of my working experiences with the SAT have been with the headquarters, International Taxation Department. That was almost 18 years, and I've only had 3.5 months field experiences up to date. So I hope you wouldn't be let down if I do not show as much field experiences as you have expected. And that's probably why exactly I need to be in the field office for a while, for some time. And back to our topic today, I think Mark has done a very good presentation, a very comprehensive presentation of the changes and challenges brought by COVID-19 to transfer pricing. I agree with Mark that a disruption of the supply chain would indeed have a great impact on transfer pricing because of the losses it causes and the possible relocation of functions of value chain that may follow. In terms of the supply chain here in China, at the beginning of the COVID-19 outbreak, the supply chain was significantly disrupted due to lockdowns and quarantines, causing across-the-board losses to domestic businesses and also posing challenges for many multinationals who have their value chain in China. But with strong and effective pandemic control measures, progress in reducing labor constraints and maintaining stability of the supply chain occurred gradually. In China, we also see the booming of the digital economy due to COVID-19, with more new business models and technologies emerging from the challenge. While since many of these are domestic businesses earning income from the domestic market, they do not necessarily pose an international transfer pricing issue. But I think the same principle should apply when it comes to the domestic tax administration. That is, you always need to strike a balance. On the one hand, you need to maintain the fairness and the integrity of the tax system, while on the other hand, you want to give some legitimate room for these new types of businesses to grow. From a micro lens, companies are accelerating their digital transformation. For example, they're more willing to use digital infrastructure to manage supply and production risks during the COVID-19 pandemic. And on the side of the tax administrations, China, SAT, has also enhanced its effort to utilize digital means to provide services to taxpayers. The non-touch tax administration, as we call it. Up to February 2021, taxpayers have been able to handle over 90% of their tax matters online. And we have also discussed and concluded MAP and APA cases online with our counterparts in Japan, South Korea, the United States, and Switzerland. Well, these digital transformations were in response to the pandemic, but will be profound and long-lasting even after the pandemic. So in China, we see them as opportunities that arise out of a crisis. I also agree with Mark that tariffs would have an impact both on the comparability analysis and on the supply chain. Changes in tariffs, whether it is an increase or a reduction, would result in a change of multinational groups' cost structures, and therefore may cause them to revisit their functions and risks and adjust value chain allocation based on the new cost structures. So given the material impact COVID-19 would have on business world, it is expected that more international tax disputes may arise, including transfer pricing cases. The disputes may come from misalignment between taxpayers and tax administrations and between different tax administrations in respect of how to deal with the impact of COVID-19 on transfer pricing. I think it will always be important to see what independent parties would do based on the arm's length principle. And there's no one-size-fits-all solution. And consistency between before and after COVID-19 should also be maintained. Here I quote an example from the OECD guidance on the transfer pricing implications of the COVID-19 pandemic. Concerns may arise where before the outbreak of COVID-19, the taxpayer argues that a limited risk distributor did not assume any marketplace risk and hence was only entitled to a low return. But after the outbreak argues that the same distributor assumes some marketplace risk and hence should be allocated losses. In this case, the commercial rationale for such a change should be carefully considered and analyzed. Yeah, back to you, Mark.
Yeah, let me just ask you a question. Somebody just asked a question and I tried to respond to it quickly. How do you deal with risks with a limited risk distributor? And I think the answer is, even if you're a limited risk distributor, you're bearing some risk. You might be bearing some of the risks of delays and disruptions in the supply chain because they're impacting you. You're the same with tariffs. And limited risk distributors also have a certain level of market risk. So I don't think LRDs get a free ride, but they're certainly not going to be in the same position as a full-fledged distributor. I wonder how you think about that, Jan.
Yeah, sorry. So you were talking about a limited risk distributor, whether they shall be entitled to have a loss or not.
Well,
I thought my job was done, and I went out of the room to have a sip of water.
No, I think I'm sorry, Jan. I think the point is that limited risk distributors do bear certain amounts of risk. They're not going to bear the same amount of risk as a full-fledged distributor, but supply chain disruptions, tariffs, certain market risks, you have to delve into the details, and I wonder how you would look at something like that, particularly in China, where a lot of people do set up as limited risk distributors. I mean, you can't push everything back to the principal. Yeah,
well, I agree that this needs to be analyzed on a case-by-case situation. It depends on what risks the taxpayer originally has assumed. If it is limited risk distributor, I think usually marketplace risk is not undertaken by such a distributor. Well, and the interesting thing is that in China, actually, while some industries have experienced a deeper contraction, while some other industries have recovered very quickly and have even been doing better than before. So in this case, we do not see that the marketplace has the taxpayer has not suffered any losses from the marketplace risk, but has actually been doing very well, have made a lot of money even in this pandemic. But certain industries, not all of them.
Yeah,
But in this case, I do not think it's the other way around as compared to the example I just gave. The taxpayer cannot argue it was a limited risk distributor and can only be entitled to a routine profits here in China. But after the pandemic, claims it should undertake marketplace risk and suffer a loss. While on the other hand, I think it would also be unfair if we say you are doing well in this market, then you should be subject to a higher return because of this. If the profile, if the delineation of the transaction was indeed a limited risk distributor, I think that applies both ways.
Yeah, I tend to agree with you on one level, but the test of a limited risk distributor is going to be in their legal agreement with the parent company.
Yeah.
And whether they're provided reimbursements for certain brand building expenses doesn't necessarily alleviate that they have some market risk. And whether there's been disruption in the supply chain and they're not being able to service their customers as quickly as they're supposed to, that may not be in your agreement, but and I'm not saying that the risks are as significant, but they could have some risk. And just calling someone a limited risk distributor without delving into the details of the legal relationship between the parties and seeing what risks are being covered by the parent versus bore by the distributor gives opportunities for you to take a look at whether some of that risk should be shared. And I think that's important, because if you line up 5 companies, then they all call themselves limited distributors, you probably have 6 different profiles. So it's not necessarily going to be the same.
Mark, I'll give Jan 1 minute to respond if she can, because we have to.
We have to get the toe. Yes.
Yeah, I think I'm almost done.
Huh?
Unless other people have some questions, I'm almost done.
All right. Thanks, Jan.
Good. So I think it's a good opportunity to turn to Tove for her comments. Tove.
Yes, thank you, Michael, and thank you, everyone, and not least to you and Desta for the invitation again, as well as to the other panelists for, I think, a very, very interesting discussion. First of all, the starting point that we as a civil society network take in this discussion is that tax revenue is going to be absolutely crucial to get us out of the crisis and to protect the most vulnerable and to fund the recovery, and not to mention the healthcare, and to fight inequality. And unfortunately, this crisis has so many faces, but one of the effects is that we're seeing a revenue crisis. It's extremely difficult for governments to get tax income. And in this context, the corporate income tax is extremely important. It's generally a progressive tax. It's a very important alternative to, for example, consumption tax and value-added tax that has the effect that people who might already have lost their jobs suddenly have to pay more for basic goods in the supermarket, and there's a high risk that such taxes will really impact the people that we actually need to look at protecting. And this is where the corporate income tax is so important, and also quite smart in the sense that it taxes profits. If there are no profits, there'll be no corporate income tax. So it's very important to get a corporate tax system that works, and not least an international corporate tax system, because of course we're seeing multinational corporations play a bigger and bigger role in all economies around the world. But also in this COVID discussion, there tends to be a lot of focus on extraordinary losses. But as I think several of the panelists before me have also touched upon, we're also in some cases seeing extraordinary profits already now. And in other cases, as Jan also mentioned, we also can see a very quick recovery, so that corporations that have losses now might actually go back to being very profitable in the years to come. So we need a corporate tax system that works, and it needs to work internationally. And unfortunately, I think as this debate also illustrates really well, what we have is a transfer pricing system that was highly complex even before we added all these aspects of the COVID crisis. And I have to say that when in my organization, when we get asked, how do you make the transfer pricing system work in, for example, a least developed country, our general answer is you don't. This transfer pricing system, even in countries with highly resourced tax administrations, the system isn't working. We're seeing, for example, in several European countries, large-scale corporate tax avoidance cases and a lot of struggles to get this system to work. And so generally our caution on this is that there's no capacity building in the world that's going to make a broken system work. However, for the sake of the exercise today, a few things that we think are important for governments to consider is, first of all, trying to avoid making it worse. There are, for example, now many countries that are considering new rules and procedures for allowing corporations to carry losses backwards or forwards between different years. And this risks opening up some Pandora's boxes, for example, introducing new tax incentives where we don't really know how big the impact of the new rule will be before we see the effects after corporations have used it. But also on carrying losses forward, we also risk opening up new tax avoidance opportunities in the future. And especially if we're looking at a future where some corporations recover fast and start making big profits, of course, it's important that we don't have even more tax avoidance opportunities than we had to begin with. On the issue of advanced pricing agreements, this is also a big discussion, but generally we always caution tax administrations when they're considering signing on to legally binding agreements that put limitations on what the tax administration can do, especially in a situation where like this, where information is difficult to get. And as the word advanced pricing agreements suggest, of course, the tax administration is signing on to agreements about how the rules will be applied in the future. Some of the biggest tax avoidance and state aid cases we've seen in Europe have actually been about advanced pricing agreements. And it's often the case that these agreements suddenly are used in ways that perhaps were not anticipated when the agreements were signed. And so, and this brings me to a very important point, which is that our general hope is that we can have a new tax system to replace this mess. And 2 years ago, when the OECD led process on the taxation of the digitalized economy started in the inclusive framework, we were very happy to see that there was a new discussion on taxing corporations on the basis of their global profit. And allocating taxing rights based on a formula, because this is for us an important alternative to the transfer pricing system. However, the Pillar 1 negotiations, as was also mentioned, they've ended in a situation where now the suggestion is to run two tax systems at once, to keep the old transfer pricing system, and then for a limited number of corporations, then run a new tax system that looks at the global profits in addition to the old system. And this is where we're concerned that we might end up keeping the old problems and adding new complexities to the problems we already had. On Pillar 2 and the discussions on the minimum effective corporate tax rate, our first concern is that the rules might not be effective, that they also look very complex. But secondly, we find in the latest negotiating text that there is a clear discrimination against developing countries, because there is a primary taxing right given to the countries where the headquarters are located, the headquarters of multinational corporations. And of course, we know that generally most of the headquarters are in developed countries and large economies. So we're concerned that there is actually a new type of unfairness being built into these rules, in addition to the fact that we're fearing the complexities and that the old problems will continue. And this is my last point, is that we really welcome that the United Nations organizes webinars like this. We also really appreciate the expert work that's going on at the United Nations, and I think the new considerations on a new Article 12b for the UN Model Tax Convention is extremely important, and we're really interested to see what happens there, and we hope the UN Tax Committee finalizes this article very soon. But we also want to flag that just recently there was a new report from a high-level panel known as the FACTI panel that was released. A really interesting and important report. And one of the key recommendations in this report is that countries should negotiate a new UN tax convention. We find this extremely important because if it's negotiated in the UN, it would mean that all countries participate as equals. But it will also mean that we can finally look at the more fundamental problems in the tax systems and all the issues that haven't been considered in the OECD-led negotiations in the inclusive framework. So this would be an opportunity to try and design a tax system that works for all countries, including developing countries and not least, of course, the least developed countries. So we think this is really important. And until then, of course, we need to have these really complex discussions about how to make the transfer pricing system work as well as we can. But we also really, really hope that there is light at the end of the tunnel, in the sense that looking at getting a new system where we can get rid of some of all the complexities that we're facing. Thank you again.
Thank you, Tove. And we have, it's very important to have the NGOs involved in these events, so it's really helpful to have that perspective. We have very little time for Q&As, but we'll carry some of them over to the fourth session. But I wanted to throw one to initially Carlos, and then very quick reactions from other panel members. And this is from Kalale Mbwe, and it reads, even for industries that are overall benefited from the situations brought about by COVID, of which we've heard there's several, there are some that may have benefited more than others in the same industry. As an example, Zoom in Zambia gained so much popularity compared to Skype. This is so even though Zoom is largely a new concept or platform in Zambia, hence can be deemed new on the Zambian market compared to Skype, which wasn't by any means penetrating the market. What comments surrounding these kinds of situations can you have in determining comparability? I don't want to talk about particular companies and certainly not about their tax affairs, but this idea of a new player and an older player and the new player penetrating the market. Carlos, can you give some ideas about the issues that might arise in looking at comparability in these situations?
Yeah, thank you. Thank you, Michael. I think that the sudden changes that have been as a result of this new situation has brought more difficulty to understand businesses. And for digital businesses, most of all, we need to really understand what's going on. So I think my takeaway would be that we need more transparency from companies to understand their business, to know how their numbers look like and how their projections look like, because there it's going to be really difficult to find comparables in the market. So, and I don't want to even talk about like the profit split methodology, because when we we don't have comparables, then we would need to find a solution through financial valuation methodologies or other methods as well.
Thank you, Carlos. Any 1-minute responses from Jan or from any other panelists? Jan, did you have any thoughts on that general issue? Mark, any thoughts?
I just want to make clear that while we've talked about some companies that have tremendously benefited from the pandemic, and I would agree digital has done so. If you just look at the comments on the U.S. stock market, the U.S. stock market has gone up very well, but it's been based on less than 20% of the companies in the United States, which means that the companies that haven't been doing well are largely in the majority, not the minority. And what that does is it really does put attention on comparability, because who's comparable to Google? Who's comparable to Amazon? Who's comparable to some of these big companies? They're in an oligopoly economy. They're the leaders of the economy. Not every business that's been hurt is it that leadership role. So let's not to get too carried away with the fact that some companies have done well when the vast majority of them have not. And we're hoping as the vaccines get released, and they're, at least in the United States, they're coming out much more quickly, that the latter half of 21 is going to start to see a spurt in these middle market companies and these smaller companies in doing well, and hopefully that'll get reflected in the data, the comparable data for future years, that we'll be able to get back to dealing with comparability standards the way we traditionally have. But don't make the mistake of thinking just because some companies have done well that the majority of them fall in that category.
Thanks, Mark. Any comments from Jan?
Yeah, thank you, Michael. Well, I think compared to developed countries, developing countries do have a greater difficulty in obtaining comparables because of many factors. They originally already have a scarce of comparable data, but in the face of the COVID-19, this difficulty becomes even worse, because prior to the COVID-19, they often had to rely on information from other geographically closest markets. But during the COVID-19, different markets may perform differently. So in transfer pricing, comparables from the geographically closest countries may need to be reassessed. So that is the difficulty I see in terms of comparability for developing countries as compared to developed countries. Thank you.
Thank you, Jan. Tove, did you have any quick comment on that?
Well, comparability was always the issue, that the first one we pulled up to show that the transfer pricing system is based on fiction and an assumption that isn't true. I mean, the type of items that get traded internally in a multinational corporation, to find an independent market where such items get traded, of course, that's not possible. We've seen the European Commission in its state aid cases try to find comparables for items such as coffee bean roasting know-how, and there is no independent market for such items. So there's a much more fundamental problem with the comparability, the search for comparables. And indeed, it is, of course, even worse in developing countries. And now comes COVID on top. So my only comment is that we need to find a system that works better than the transfer pricing system does.
Thanks, Dove. And thank you to a fabulous panel. I mean, we're really privileged to have such a diversity of views and such top-level experts. So thank you very much. And it's much appreciated, and some good thought for not just the participants, but also for the future UN work. So thank you, panel 1, and we'll now move to session 2. So if we can have the panelists ready on that. Thank you again. Again, I'll very briefly introduce our panelists. Now, the first speaker is actually speaking by video, and that's Emily Muir from the International Bureau for Fiscal Documentation, the IBFD. She's a managing principal. She's of the for Sub-Saharan Africa at the IBFD. She's also a member of the UN Transfer Pricing Subcommittee and has done some important work in that body. She's also a visiting lecturer at the University of Cape Town, South Africa, and the University of Amsterdam in the Netherlands. Now, Emily couldn't, for reasons outside her control, couldn't personally be here, but has left us a video, which Sean will, I think, now play. And that will be the introduction to this panel. The other panelists are Jose Troyer. He's currently holding the position of Large Taxpayers and International Taxation Coordinator in the Ecuadorian Tax Administration, working on transfer pricing policy and risk assessment. And he's also a member of the UN Tax Committee. And the final speaker is Manuel de los Santos from the OECD. We're always very happy to have our brothers and sisters from the OECD participating in our events. He joined the OECD transfer pricing event in 2016. Since then, he's contributed to the major transfer pricing projects of the OECD, working on Pillar 1, but also leading the project on financial transactions, which is very important in this area. Before joining the OECD, he worked for the European Commission and the Spanish Tax Administration, mainly in international tax and transfer pricing. So if we can listen to Emily, and then we'll have comments from Jose and Manuel. Do we have the video, Sean, or do you want me to briefly go through Emily's slides? Do we have the video?
Yes, Michael, we should momentarily.
Thank you.
Conditions there can be. So comparability analysis really in the context of the pandemic, first to begin with, comparability analysis is at the heart of application of the arm's length principle. And basically what we are saying is that when you're looking at transactions between related parties, we want to approximate the outcome, so the price or the margin, to what would have happened if the parties were not related. And this becomes even more important during the pandemic period.
If we can increase the volume would be good.
Or where things have been affected globally between taxpayers, in countries, in market, in industries. So it becomes really crucial for us to understand how a comparability analysis in transfer pricing would be or would look like during the pandemic period. Some of the key considerations that I have set out for you today, considering also that my topic was really to look at the issue of lack of comparables more generally, is really to go back to the basics. And the basics demand that for you to be able to properly benchmark a transaction, you must first have accurately delineated that transaction in order to really understand what is happening between the related parties, so that you're able to approximate with what would have happened if the parties were not related. And so we really must go back to the guidance and know what transaction are we really looking at. In the context of the pandemic, for example, you might find that what the parties had agreed upon, of course, always realizing that contracts are the starting point, the parties might have agreed to something that the pandemic might then have changed, or the situation of the operation of the market, or the operations between the parties for 2020, say, and we have to go back and look what really happened in an actual situation, say for the year 2020. So if there have been certain shift in the way that operations were done in the supply chain, has this necessitated for us to look at the transaction currently differently from what the parties had actually hoped it would look like for 2020 when the pandemic was not there. So we really must go to the basics. One other key consideration in the context of the pandemic is that the economic conditions, and you would recall that economic circumstances is one of the comparability factors, if you might call it that. Economic conditions really have been affected greatly by the pandemic, in the sense that different countries, different markets were impacted differently. Companies within the same country were impacted differently. Industries were impacted differently. So in a sense, you really have to look at and understand how did the economic circumstances presented by the impact of the pandemic, how did it affect the transaction that we're looking at, in order for us to be able to properly know how to benchmark that transaction. So again, when we're looking for comparable companies, we want to be sure that we have understood how the economic conditions affected the particular transaction at hand. And in all this discussion, there's one thing that we cannot run away from, and that is the importance of documentation and data, to the sense that it is expected, of course, for transfer pricing purposes, that in order for the taxpayers to really substantiate the outcome of the transaction, so the price or the margin, they should show that they have been keeping contemporaneous documentation in order to support their related party transactions, etc., up to the point where they select the comparables. During the pandemic, of course, things changed. There was a lot of change in processes in how companies operated, and it might not always have been possible for companies to actually keep contemporaneous documentation. And it is therefore a key consideration, because companies have to show to the tax authorities that they really, what the outcome that they have, so the price or the margin is really supported by documentation, that they can say that this is what really happened in this particular transaction. So these are the key considerations that I selected, just in terms of us really trying to look at a comparability analysis in the context of the COVID-19 pandemic. So what are some of the key challenges that we see in terms of the comparability analysis? First, we have to really begin at the point where we must understand what impact the pandemic has had on different taxpayers, industries, or markets generally. Because as I mentioned earlier, all these clusters of things, taxpayer, industry, or market, were affected differently. So for example, you might recall that China entered lockdown quite earlier on before many other countries. And some authors have written, specifically Deloitte China, have written how China, in the first 2 months of 2020, everything almost came to a standstill. But this also meant that the government could put things quickly in place, enforce various protocols. And during the course of the year, the economy sort of recovered, and companies there were functioning almost normally. Some industries actually saw great returns, like the manufacturing industry. So if you look at China in that particular instance, and you look at another country which on a normal time would have been a manufacturing jurisdiction, but was affected by the pandemic in a different way, such that if you were to consider comparables, would you look at comparables, say, from China to be reliable if you're looking at a taxpayer based in another Asian country? So all these considerations have to come into play. If you're looking at a particular taxpayer industry, some industries during the pandemic were great winners, others were losers. Winners in the sense that certain industries actually had a benefit in the way in the sense that the way businesses restructured themselves, there was more need of teleconferencing, for example, and there was delays in delivery of certain goods and services. So if you look at companies that are in those two different industries, so teleconferencing and a pure service industry that requires the presence of people, so say in the hotel business, those industries would have been affected very differently. So if you're looking at these particular taxpayers, you really have to understand how the pandemic affected them during 2020. So other considerations that you would have for a comparability analysis during the pandemic is timing issues and the impact on the periods that you've selected, including your choice of the transfer pricing method. Timing issues, one, because when you're looking at the financial year 2020, if you're looking at comparables from, say, a commercial database, information would normally be available many months after companies have filed their returns or submitted the transfer pricing returns, at which point they would have set out what the outcome of their transactions with related parties were. But if you were to undertake a benchmarking analysis, which period should you then consider? Should you consider 2020? Should you consider weighted average of pre-pandemic periods? And how should you make any changes to the results you have in order to really take account of how the pandemic has affected the year 2020 and has affected the way that comparability, the way that you would normally select periods for a comparability analysis or a benchmarking analysis. You also have to consider what are the benchmarks, what is the comparables data, should you make any comparability adjustments. When you're selecting comparables, of course, the example I gave of China earlier and the manufacturing industry, there having been one of the winners around the world, actually. Would you be looking, if you're in a different market and you would normally accept comparables from China, will you accept them from 2020 if you're a tax administration in country B? So what comparables will be acceptable and how would you actually find these comparables? In the sense, again, going back to the point where we said that taxpayers were impacted differently by the pandemic. So where will you source your comparables and which comparability adjustments, if any, will be needed? Because again, the pandemic affected companies differently. Some companies had cash flow problems. And how do you take this into account once you have your set of comparables? So for countries that have had an issue with comparables in the past, so access to comparables data, either because they do not allow the use of foreign comparables, the problem is exacerbated now during the COVID pandemic because the pandemic has presented an even a greater complexity in the sense that data is not available immediately as the year is closing and as we look at the year 2020. And what, of course, each country will have its own ways of dealing with this. But of course, you would imagine that going forward, at least once the results are in and once we really have a practical outlook of how things happened in 2020, that there will be a clear way that countries can really say, this is how we expect taxpayers to have found their comparables in 2020. But as it is right now, it's just a few months into 2021, and a lot of what we have now is really the theoretical of how it should happen. But I believe that once we go into the practicals, things might change a little bit. Another issue that comes up for consideration is how do you treat government assistance? So during the pandemic, many governments around the world provided incentives for the taxpayers in the form of grants, etc. And the idea behind the assistance was really to try and cushion the companies from the adverse effects of the economic impact of the pandemic. So some countries offered incentives in the form, offered assistance in the form of reduced taxes or outright grants and subsidies. And from a transfer pricing analysis angle, we would want to know how this would be sort of taken care of in the results that will be obtained for that particular related party transaction. So one of the considerations that come to mind here is if country A has offered its taxpayer an assistance in the form of, say, a grant, how does this affect the transaction? Say, would it then lower the risk of the taxpayer? Would this affect the way that risk should have been assigned under the contract? No, not necessarily. What this would do is that it would make it easier for the taxpayer to get by, given the difficulties posed by the pandemic. Of importance, I would imagine, to developing countries is to see really that the benefit of the assistance is not washed away. So if country B is providing assistance to its taxpayers, you would want to be careful that the benefit is retained or is felt in that country and not transferred to the other country of the other related party in the transaction. Because an example is given by some authors where they talk about an arrangement where, say, the taxpayer in country B would normally be expected to get a fixed return under the contract. But due to the government assistance that country B has offered its taxpayers, country A might imagine then that it does not have to pay, the company in country A imagines that it does not have to pay its related party in country B the fixed return, since the taxpayer in country A is already facing difficulties, whereas the taxpayer in country B has been subsidized by the government. But in this case, it's important, as I said earlier, to consider and to take into account that the benefit being granted by country B must not be washed away in this, by not retaining the benefit in the market of country B. And of importance is also to see how the taxpayer has then structured its operations in the context of the assistance being provided. So some taxpayers might lower the prices of the goods they offer to consumers. Some taxpayers might, of course, take this as a sort of cushioning against any loans or financial liabilities they might have. So all these have to be taken into account. And that brings us again to the issue we talked about earlier. How do you look at the particular transaction in terms of accurate delineation of the transaction involving government assistance? So all these challenges, of course, in a normal transfer pricing analysis, you will come across them. But what has happened during the pandemic period is that the challenges have been exacerbated. So in the previous slides, we looked at what comparability would look like during the COVID pandemic period. We also looked at some of the challenges in terms of where to find comparables, what periods to consider, if there will be any adjustments needed, how do you make those, what are the reliable adjustments that will be expected, and how can those be done in terms of ensuring that the adjustments help to improve the reliability of the comparables or of the particular parameter being measured. So there, I mean, as we said earlier, really, what the COVID-19 pandemic has done, whereas before now, of course, a number of countries, especially developing countries, have had problems in terms of accessing comparables data. What the pandemic has done is to exacerbate this situation. But what the pandemic has also done is to, in a way, present certain opportunities, which if taken along by countries can go a long way in ensuring better analysis in the future. So what are some of the opportunities that have been presented or some solutions to solve some of the problems we've looked at? Key to this really is the relevance of taxpayers' internal data. So the taxpayers now more than ever are required to have their documentation, as is always in a transfer pricing analysis, to be able to support their interactions, their transactions with related parties. But crucially, the data that the taxpayer has, the internal data, will be very handy in terms of showing the tax authorities or substantiating what the outcome of the transaction has been in terms of price or margin. So there will be great reliance by tax administrations on the data that is provided by taxpayers. And also, since we said that it's not really easy to know now which comparables to look at, especially since the data will be available 6 months from now, and taking into account the different ways in which COVID pandemic has affected different markets, a lot of consideration or criteria would have to be adjusted within the databases to be sure that the final set of comparables is really reliable. But taxpayers The other way that could be tax authorities could deal with the challenge is to look at the internal data presented by the taxpayer, or look at the budgeted results of the taxpayer made pre-COVID. So in 2019, for example, what was the forecast of the taxpayer and how does that compare with the actual results of 2020? And by looking at such the comparison and just the correlation between these sets of data, what adjustments can be made in order to make sure that the impact of the pandemic has been reflected. Again, as I say, this is a practical question that can only be answered reliably once this exercise is undertaken. One of the other opportunities or solutions that could be thought about is what is the role of safe harbors or simplification measures, even if on a temporary basis. This relates and ties in with the first point in the sense that tax authorities would see information from different taxpayers within the market. But remember, the taxpayers between different industries were affected differently. And whereas sometimes, say, if you're looking at the TNMM, you might have looked at the functional profile of the taxpayers in the transaction you're considering with that of comparables who have a similar function profile without necessarily looking, say, at the characteristics of goods or services. But since the tax authority has information on a given number of taxpayers, can this information be used in a way so as, say, to develop a safe harbor fixed returns or a simplification measure of some sort that then the tax authority can maybe present the information to taxpayers as far as is possible without infringing on its duty of confidentiality, and for the tax authorities and taxpayers to agree on the extent to which that information can be used as a basis for setting price or margins. This is, of course, a long shot, but could this still be one of the things that can be done now during the COVID-19 pandemic? One key theme that cuts across all these issues is the role of mutual trust, flexibility, and reasonableness in undertaking a transfer pricing analysis. Of course, tax authorities or government expects taxpayers to substantiate their transactions in the form of contemporaneous documentation, but the pandemic presented very challenging circumstances for taxpayers that it might not have been possible for all transactions to have been documented. And of course, that then calls for flexibility from the tax authorities in terms of the kind of information or the extent or scope of information to be requested from the taxpayer, and for the taxpayer to exercise reasonable efforts to provide the information required by the tax authority. And in all this, then, there is mutual trust that one, the information that the tax authority, say, has in its disposal can or will be used, with the taxpayer trusting that that will be used reliably. Two, there will be flexibility in that the tax authority will be willing to give some latitude for the taxpayer where information is really not available, and also to the extent the taxpayers will exercise reasonableness in providing the information that is necessary to price the transactions. But looking more at a medium to long-term scenario, there is a role that could be played by regional tax bodies in maintaining the dialogue around the issue of comparability and lack of comparables, in the sense that if we look at what is happening right now in the context of Pillar 1, in the discussion about digitalization of the economy, and in there under Pillar 1, we have what is called Amount B. And what is happening there is really looking at the possibility of developing a fixed return, perhaps based on standardized benchmarks. If there be a regional tax body for countries where it is not really possible to get comparables, can this regional tax body, so say the Africa Tax Administration Forum or CEAT, is there room for these bodies to really be the focal point that if countries come together within that particular region and have purchased a database commercially together, and this access lies with the regional body so that countries within the region are able to access comparables centrally through that regional tax body, would this reduce the problem of lack of comparables for a number of countries within that regional or that are members of that regional tax body? And I would really would like myself to really call on to regional tax bodies around the world, especially within developing countries, to really see how they can move and maintain the dialogue on the issue of comparability, the search for comparables, to ensure that the opportunity that there is right now, because there has been a lot of discussions happening on a more international level, that we do not lose that momentum, we keep the discussion going. And what is the role of targeted capacity development in all this debate? Different countries around the world within different regions are at various stages of development from a tax perspective, transfer pricing more specifically. Some countries need a legal framework on which to deal with transactions between related parties. Some countries require the personnel, so people to actually undertake transfer pricing analysis or studies. Some countries need the practical skill of being able to actually deal with the whole issue of comparability, which falls within the previous category of undertaking a transfer pricing analysis. And some countries require capacity in terms of dispute resolution and prevention. So prevention in the sense of APAs, or resolution in terms of all the measures that can be utilized in order to resolve disputes. So what I would really be putting forward here as a suggestion, that for all the bodies that are engaged in providing capacity, please consider clustering countries according to the level of capacity that they require for transfer pricing. Because only by doing this can the real need of the various countries be taken into account. And in so doing, then, the issues that countries encounter in transfer pricing, and certainly to do with comparables, will be addressed in a more targeted manner and will be most beneficial to countries. So just to sum it all up, yes, comparability analysis has been impacted in the context of the COVID-19 pandemic, but there are opportunities that can be taken by countries at this moment and taxpayers to promote mutual trust and to also ensure that going forward, there can be solutions that are sustainable for all taxpayers and tax authorities. And with that, I would like to thank you very much, and thank you for having me, the UN, and I wish you the best for the remaining part of the session and of the day. Thank you very much.
We'll be sending great thanks to Emily for preparing that video at very short notice when she wasn't able to participate directly through no fault of her own, I should add. And when we put it on the website, we'll try to ensure that the volume's a little bit louder. So what we'll do now is we'll turn to Jose for some comments on the issue of comparability from the position of someone in Ecuador. Jose.
Thank you, Michael. Thank you. Yes. First, I want to thank the organizers for inviting me. I feel honored to share ideas with so high-profile speakers. I think the issues we are talking are already there, are on the table. What I want to propose is to maybe look at these issues in a more practical way, the more practical I could have thought of, and having also some ideas for solutions. First, we have specific ideas for some of the issues. For example, for access contemporaneous information, we as a small developing economy are used to have problems with finding comparables and being more flexible for some of the parameters we use to search for comparables. So we may have larger sets of comparables anyway. We are normally open to use foreign comparables anyway, so maybe that is not that new for us. Of course, and I saw one of the questions, I think it is useful to delay filing dates. Of course, data in general could be delayed, so if we also delay filing dates, could be useful. Publish information available. I think this matches a little bit what Emily also said. I think that regional bodies could be very helpful for publishing information that may be already available or making information that now is not available, making that available. That will help us not only because of COVID, but also because in general we need that information. For government assistance, I think that it is very complex, and it could be something to think about to disregard in general comparables that have been subject to government assistance. Anyway, if you need to study the accounting treatment, because the government assistance could be really different, and you have to study that. For risks and contracts, I want to have a different view, or maybe to contribute to the discussion we have in the last session, because I think it's very important to at least be coherent. That for me is that, of course, low risk doesn't mean no risk. So low risk normally have lower impact, and if in the past low risk distributor or low risk manufacturer was not awarded any extraordinary profit, I think that it is current not to assign it an extraordinary losses. But on the other hand, if tax administration have argued or have the position that a distributor or a manufacturer is low risk, then of course some of the losses, special losses because of the pandemic, should also be at least partially assigned to that taxpayer, as profit was assigned before. So I think that at least we need to be coherent. Next slide, please. For extraordinary costs, of course, think about if they are just extraordinary or just new, because the world has changed, and in many ways we are going to have a new way of doing business, and of course new costs. Also study accounting treatment, of course. To find out what are the extraordinary losses or profit for businesses, and I think this is useful not only for the comparability analysis, but also for targeting your compliance activities. You can study the industry sector information, for example, with your VAT tax returns. Also understand the economic circumstances, as Emily said before. For working capital adjustments, also a tip would be for me that since countries have different impacts, and it is normal to have different paying terms, probably the collecting terms have been increased, and also the paying terms for your taxpayer. So you have to be more careful, and working capital adjustments are even more justified for me if you use foreign comparables and foreign comparables from different countries. So maybe you should adjust all the comparables and also your tested party. That would be for me maybe to think about the working capital adjustment to zero, so that takes into account the particular circumstances of each country. For general comparability adjustments, one tip could be to use information, normally taking into account that you have more information about the industry in your country and the taxpayer in your country. So you may use information from previous years for comparables, and then adjust the COVID circumstances for your local tested party. Next slide, please. As broader solutions, that was about particular issues in comparability, but I also think that I share some of the solutions proposed by Emily. Also, I think that, as I said before, risk assessment could be really interesting, because maybe we think that COVID may have a lot of problems and exacerbate the problems of comparability that we already have. But I think that maybe you could, as a small developing country, tax administration, you should be very careful about your resources, your scarce resources, and of course focus on where the risk is. And maybe some of the taxpayers that have received, for example, government assistance for surviving are not in your risk profile in the highest position. So maybe you should focus more in the industry with extraordinary profits, previous years and years after recovery. Also introduce transition regime with simple approach or even safe harbors that is shared almost exactly with the presentation by Emily. But I think that this could be discussed even in a longer term solution for our countries. And also, as I said before, improve the information available to tax administration. That is, maybe it's time to ask local companies to publish more information about the financial statements and quality information about the businesses. And that could target not only for transfer pricing purposes, but also in general transparency issues that may have other advantages for your country. And that's about it. Thank you, and I am open for any further discussion. Thank you very much.
Thank you, Jose. I think we'll pass to Manuel, and then we'll have a brief time for questions at the end, and of course, questions in session 4 as well. And the other thing is there will be, at the end of this session, we'll have a brief break for people to stretch their legs to get a cup of coffee or whatever. So we'll pass over to Manuel, and thank you, Manuel.
Thank you so much, Michael, and thanks to the previous panelists. I mean, it's a real pleasure to be here and having the opportunity to share with you some of the insights that the inclusive framework included in the guidance that was released at the end of last year. So really happy to be here. You know, Michael, you just put me in a very difficult spot because I'm just standing between the attendees and the break. So I'm trying to make it short and interesting. So for the next, let's say, 8-10 minutes, I will be walking you through the main issues that we covered in the guidance, as I said before, was released in December last year. And I think to start with, it would be good to provide like a general overview of why this guidance is remarkable, and then getting into the technical details. I think the guidance is remarkable for 2 reasons. The first one, it's highly timely in the sense that it was produced in a very short period of time with the collaboration of not only the delegates of the inclusive framework through the working party number 6, but also through the contributions in the scoping exercise of business, where we gathered inputs in order to make sure we were addressing the most pressuring issues when it comes to the impact of the pandemic on the transfer pricing analysis. The second point, I think it's remarkable because it was approved and released on a consensus basis. And that means that the guidance actually represents the consensus view on how the transfer pricing guidelines, but more broadly, the arm's length principle apply to situations that arise or may be exacerbated by the COVID-19 pandemic across more than 135 countries. And I think that's something that is important to stress and to highlight. In terms of like the feedback we've received so far on the guidance, we've received quite positive feedback from both tax administrations and taxpayers. On the side of the tax administrations, I think the guidance have been found useful because it provides with commonly agreed framework within tax administration can have discussions and can have an open conversation about how the transfer pricing it has been affected by the pandemic. And from the point of view of business, the guidance has been also very welcome in the sense that it has allowed business to use the insights of the guidance for the closing of the financial year 2020. But at the same time, because as I said before, and I think again it's important to stress that it represents a consensus view of the inclusive framework. So that's always comforting for businesses to read something that is going to be applied on an homogeneous basis across the inclusive framework jurisdiction. Another question before getting into details that we usually get when we come out to speak about the guidance on the transfer pricing implication of the COVID-19 pandemic is what to expect in the future from the inclusive framework in this particular space. So the inclusive framework, and in particular the working party number 6, does not have any plan to revisit the guidance in the short term, but that doesn't mean that we are turning our back to the problem. Just the opposite. The working party number 6 will keep on monitoring the situation and will be ready to react if new information is available that justifies including new issues or analyzing new aspects of the COVID-19 pandemic on the transfer pricing arena. So I'm going to start getting into the details, but very briefly because I'm conscious of the time. I think, as you all know, the guidance includes 4 chapters. First one on comparability analysis, and I think that's the most pertinent for this panel. Then we have another one addressing losses and the allocation of specific or extraordinary costs related to the COVID-19 pandemic. We have a chapter dealing with the impact of government assistance programs on the transfer pricing analysis, and finally, chapter 4 dealing with advanced pricing agreements. I think to start with, it's very useful to recall the opening of the guidance, where it states that the arm's length principle and the OECD transfer pricing guidelines is still fit for purpose in the current environment. And I think that's an important message because we are talking about let's say, a very principled approach, which is covered in the transfer pricing guidelines. And that approach is flexible enough to cover situation regardless of the point in the economic cycle for different business and industries involved. So starting with that, moving into this first chapter, the comparability that analyzes the impact of the pandemic on the performance of the comparability analysis. The chapter starts by identifying what is the main challenge that the performance of comparability analysis is going to face in the current situation. And that's something that has been touched upon by different panelists before myself. And it's the difficulties and deficiencies of the information available for those periods affected by the pandemic. So it's obviously a problem, the lack of contemporaneous information, but it's also something important to stress that this is not something specific to the situation we are currently at. It's not something new to the transfer pricing analysis that the lack of contemporaneous information, it's a difficulty to overcome. And it's something that could also be faced quite frequently when it comes to the application of certain transfer pricing methods, like for instance, the TNMM, that usually relies on information coming from previous years than the year where the transaction has been entered into. What is actually true is that those issues might be more relevant, or that issue, the lack of information, might be more acute in particular scenarios of the current pandemic. But again, I think the guidance is cautious. The guidance provide caution when it comes to generalizing, because there could be situations like, for instance, long-term agreements where the pricing has been set for a long period of time that might not be affected by that lack of information in a particular period affected by the COVID-19 pandemic. I think an opening remark as well in this chapter is that both tax administrations and taxpayers are encouraged to confront the challenges related to the performance of comparability analysis with an open mind, taking into account that it will be necessary to exercise commercial judgment in order to get an outcome as accurate and as precise as possible, but being conscious of the difficulties and challenges on gathering information that both sides are going to face in the current environment. Having said that, the guidance provide a number of recommendations or a number of hints in order to help sorting out the problem related to the access of information. The first one is that the guidance includes a list of different sources of information that I think they could be seen as a more pragmatic or broader than the usual transfer pricing information that we relied upon to perform a comparability analysis. And I think that links to the point about the need to do or to exercise that commercial and good judgment when it comes to apply the transfer pricing rules for periods covered by the or affected by the pandemic. And one of those examples could be, for instance, using budget information in order to inform the determination of the price of the control transaction. And something also that has been picked in one of the questions I've checked out in the chat, it's the possibility of using statistical tools in order to forecast what would have been the impact of the pandemic based on the impact of previous economic downturns to the tested party. But in that point, I would also like to highlight that the guidance is pretty cautious when it addresses the use of information coming from previous economic crisis. And the reason for that, I think, is quite obvious, is that economic crises, they look alike in the surface, but they have different features when you get into the weeds, and also the impact of those of the different economic crises has not been even across the different industries. So again, picking up on one of the points that we've been presented before by some of the panelists, it's important to understand how the crisis is impacting a particular industry, but not only the particular industry, but also the different entities or groups operating in each of those industries. When it comes to some sort of methodologies to address that problem, aside from broadening the source of information that could be used in the transfer pricing analysis, the guidance also point out to a number of recommendations. The first one is encouraging countries and jurisdictions to the extent possible to use the outcome testing approach, and because that will allow to incorporate information available after the closing of the financial year, even if when that information is available before the deadline for filing the tax return. And that also links to another recommendation, that is allowing taxpayers to use price adjustment mechanisms. But in both cases, obviously, the guidance is very cautious that at the end of the day, this is a question of domestic implementation. So it's the discussion of that point is framed within the limits of what countries can do under their domestic legislation. Another point encouraged here by the guidance when it comes to strengthening or addressing the difficulties that the performance of comparability analysis could carry is using or suggesting the benefits of using separate testing periods as compared to using multi-year analysis. And that discussion, again, is framed within the context of the OECD transfer pricing guidelines, in particular chapter 3. But there might be situation in the current economic environment where the use of separate testing periods could help to provide a more reliable outcome when it comes to analyzing the pricing of control transaction. And finally, on that point as well, the guidance recognizes the possibility, already included in chapter 2 of the transfer pricing guidelines, of using more than one transfer pricing method in order to, I think it was Carlos saying before in the first panel, making sure that we have some sort of sanity check or a supplement information in order to provide a transfer pricing that is as accurate as possible in the current scene. There are other chapters in the guidance, but I'm conscious of the time, so I'm going to just comment that, whenever or whatever question attendees may have, I'm very happy to pick them during FAQ session afterwards. But in order to wrap up the session, I think it would be important to take away the message that the guidance is actually positive and remarkable because it stresses or it represents the consensus view of a wide number of countries in the inclusive framework. And I think that's one of its main strengths, especially when you look at those from the perspective of developing countries, because it provides, practical recommendations. It somehow, in some aspects, provides some flexibility to the more traditional application of the transfer pricing approaches, including the transfer pricing guidelines. And finally, as I said before, I think it's important to frame that guidance in the current economic circumstances where it's supposed to be applicable. And also keeping in mind that the guidance is framed within the arm's length principle and the OECD transfer pricing guidelines. As I said before at the very beginning of the presentation, the inclusive framework countries consider that those still fit for purpose in the current arena. So thank you so much, and Michael, back to you.
Thank you very much, Manuel. And it's always good to have a positive message in these times. And thank you. That guidance, I think, is something that everyone should read. I have a question from you, which Jose answered from his perspective, and it's from Jesus of Mexico, who says, wouldn't it be a good idea to suggest deferring transfer pricing reports until the end of 2021 to wait for comparable data using profit-based methods? What do you think of that approach?
So I would be also interested in hearing Jose on that one, because it's related to the day-to-day life of the tax administration. Obviously, the guidance that we've produced doesn't cover that specifically, in the sense that the filing periods, it's something determined by domestic legislation. But I think it's very much related to one of the points I was touching upon when I was talking about the chapter on comparability, and it's the fact that the guidance encourages countries, jurisdictions, to the extent possible, to allow for the use of this outcome testing approach, and also pricing adjustment mechanisms. So that allows taxpayers to have some extra time in order to gather information that could be relevant to the financial year 2020, if that's the year we are considering, but that may only be available, for instance, at the beginning of the financial year 2021, and still, giving them some time to incorporate that into in their transfer pricing analysis, in order to provide what we are looking at, or what we are looking for, is getting the most reliable approach to the arm's length price, to the control transaction we are considering.
Thank you very much. Jose, did you have any further thoughts on that issue?
Yes, just very quickly, I think that if it is possible, is an option that should be taken, because since so many factors have changed, it is better to have the information of the year, of the contemporaneous information. And of course, the consequences of delaying the filing, I think, are not overweight by the advantages. Thank you.
Thank you. There's a good question about regression analysis, but I think we'll keep that to the fourth session. But I have another question for you initially, Jose, and it's from Marcia from Uruguay. She says it was always important to have information on comparables in the domestic market, but it will be essential in the context of the pandemic. We believe that the profit split method will become more important. The tax administration of Uruguay has applied it in some cases with success. We do not agree with using safe harbors. We need firstly to try to use the mentioned methodologies. A lot of very important issues in there, and I'd like your thoughts first, and then Manuel. Thank
you. Yes, I think that for safe harbors, we should be open-minded. I mean, not only safe harbors, it could be like simplified methods, so to say, because at the end, we have limited resources, And I think that if they are well designed, it could be useful anyway. For profit splitting, I think that the profit split method could be useful, but we sometimes have the same issues about information. You have to rely on information that is internal to the parent company, maybe, and you don't have a way to check if in the other jurisdiction that the information is correct. So they have some information issues for profit split. I take the advantage to also give how do you say a publicity to the new chapters of the transfer pricing manual the UN committee is going to issue this year. We have good guidance about the profit split method. And of course, I agree that countries should think very thoughtfully about using local comparables and have more information about local comparables available. Thank you.
Thank you, Jose. Manuel, any thoughts on that issue?
Yeah, Michael, if you allow me, I'm going to reply to the question you put before, that reference in the chat about the use of regression analysis and statistical tools, because I think it's a very pertinent one. And I think it's also something that has been echoed in the guidance that was produced by the Inclusive Framework last year. And when I was mentioning some of the alternative sources of information that taxpayers and tax administrations could rely upon in order to form a transfer price that is aligned with the Amsterdam principle. Actually, the guidance recognized the possibility of using a statistical method such as regression analysis. So the idea there would be to use those tools in order to predict the variation of, for instance, the profitability of an entity, that entity being the tested party or one of the comparables, based on the variation of another variable, in this case, the GDP. So the idea behind would be to check out how the profitability of an entity of a comparable was affected in a previous economic downturn based on the variation of the GDP, and then extrapolating that to the current economic situation. I just wanted to highlight that because I think it's useful. It's one of those examples we include in the guidance that I think is quite pragmatic, and I think it could be useful.
Thank you very much. And we've concluded this session. There are still some Q&As which we'll try to deal with in the fourth session. Thank you very much to Emily in her virtual presence, and to Manuel and Jose in their a slightly more here and now virtual presence. It's been a wonderful analysis of some of these issues, and we'll address some of the issues further in the Q&A at the end. So thank you very much, and we'll have a brief break now for 10 minutes until 25 minutes after the hour, and we'll see you there for session 3, which will be chaired by my colleague Josephine. Thank you very much, panelists and participants. Goodbye. Thank you.
Hello, everybody. Welcome back to this third session. My name is Josephine Mushiri from the International Tax Unit of the Financing for Sustainable Development Office. In this session, we shall be looking at dispute avoidance and resolution mechanisms in light of the pandemic. And we have panelists, we have excellent panelists that are lined up. And first up, we will have Matthew Gubojula from Nigeria. Matthew is the Director of Tax Policy in the Federal Inland Revenue Service. His experience spans tax audit, investigation, policy, transfer pricing, and international tax. He is currently a member of the Transfer Pricing Subcommittee of the UN's Committee of Experts on International Cooperation. He co-chairs, he's the co-vice chair of the Inclusive Framework. He also co-chairs the OECD Working Party 6. Previously, Matthew has also chaired the Cross-Border Taxation Committee of the African Tax Administration Forum, and we are really excited and happy to have him here with us to share with us his experience. The panelists will be John Hughes from the USA. John works with the Internal Revenue Services. He's a director in Advanced Pricing and Mutual Agreement Program of the Large Business and International Division. Currently, he chairs the OECD Forum, FTA MAP Forum. And prior to his current appointment, John has worked on tax treaties, he's worked in the transfer pricing operations area, and he's also been at the Washington offices of Meyer Brown, the LLP. We also have Janine Jugens from Unilever. Janine is the Vice President of Global Tax at Unilever. She joined from Rio Tinto, where she was the global head of tax. Janine has over 30 years of international corporate tax experience. She's gained it in various companies. She has worked in the energy sector, engineering, mining, and consumer goods. She's been involved in a lot of the international tax work. Key among them is she presented on practical perspectives of a multinational company in the OECD PEPS project and Pillar 1, the tax policy and design considerations of natural resources taxation regimes, and the subject of tax transparency. She's also contributed a chapter to the IMF book on international taxation and the extractive industries. We are very excited to have Janine on board with us. And without further ado, I will pass the floor over to Matthew, who will be the first presenter for this session. Thank you, Matthew, and welcome.
Thank you very much, Josephine, for that introduction. The objective of this session is to discuss the impact and challenges of the challenging economic circumstances caused by the COVID-19 pandemic. I have slides which I'm sure Gabriela or somebody is going to put up for us to go on. Can I have the slides on, please? Thank you very much. Can we go to the next slide? Thank you very much. No, this cannot be it. I'm sorry, I think the control unit office is trying to locate the right slides to put on. If we are having challenges, I can actually share my screen if that is okay with us. Oh, thank you. Sorry, can we please go to the beginning if you can hear me? Yeah, thank you. Can we go to the next slide? I'm afraid it appears we are not having the right slide, please.
Just 1 minute, Matthew. We are fixing the issue at the background. It will be up in just a bit.
Okay.
Yeah, there we go. Thank you. Thank you for your
patience.
patience.
Thank you. That's good. Now, eliminating barriers to cross-border trade and investment is a very important a step to ensuring economic growth, particularly in developing countries. And in order to achieve this, the proper legal framework is required, and that will enable the system to minimize the risk of uncertainty for taxpayers, for investment, and also enable for peaceful and quick dispute resolution, and also ensure that there are no double taxation. And one of the ways this could be achieved is by ensuring that dispute do not arise by way of advance pricing arrangements, and where such happens, then the provisions in the domestic legislation may help to resolve and then finally there could be we could resort to MAP, that's mutual agreement procedure under the relevant tax treaty. Next slide, please. Next slide, please. Now, when we talk about dispute resolutions, there are a number of tools that are available to tax administration. There could be administrative remedies, which could be alternative dispute resolution systems. For example, in Nigeria, for transfer pricing cases, we have a system of what we call decision review panel, wherein before cases are taken to court, a group of experts in non-judicial capacity will look at the issues and then be able to advise either party on the way to go. We also have a cooperative approach to resolving problems. For example, also in Nigeria, there is a system which we call enhanced relationship, where a group of taxpayers in the same industry engages with the tax authority to resolve common problems. And as such, it is a lot informal, it is very quick, and not based on strict legal interpretations. And of course, there could be negotiations, there could be mediations. However, there are judicial remedies, like we could have dispute resolution panels, like tribunals, like ombudsman. The courts could be there. There could be international arbitration. And I know that this is a very difficult form for many developing countries to adopt. But I know that in a number of trade agreements, there are arbitration provisions. And of course, finally, which is very important, which is usually at bilateral or sometimes multilateral basis, is the issue of mutual agreement procedure. Can we go to the next slide, please? Now, how do we prevent dispute, particularly in a time like this, where there are a lot of uncertainty in the business environment? One way that some countries have tried to do this to suspend tax collection, particularly during the period of a pandemic, there were a number of reliefs given to taxpayers in different tax authorities, some including suspending collection of taxes. But again, this has a challenge, as many developing countries require necessary funding for them to even engage and provide a solution to health challenges arising from the COVID-19. And so it may not be a very popular option in developing countries. We could also look at issues of safe harbor, which can also help by benchmarking specific activities or transactions, especially where we have organized and regulated industries, like in the financial sector or in mining or extractive industries, where the government have a lot of regulation on. There could then be agreed benchmarks that could be adopted as a form of safe harbor. And the last one there is to have either bilateral or multilateral APAs that will provide certainty in advance in respect of specific transactions. Can we go to the next one, please? Now, when we speak about APAs, APAs are forward agreements. They are forward agreements that are entered into in respect of transactions that are expected to happen in the future. time, and it helps to really where it is the transactions are of continuous nature or repetitive nature. APAs can be multilateral, it could be bilateral, it could be unilateral. But most often, the most productive APAs are those ones that are bilateral or multilateral. Unilateral APAs may expose taxpayers to double taxation, where the other country would not agree with the agreed pricing with the taxpayer. Generally, APAs are voluntary. Voluntary both for the taxpayer and also to the tax authority, and it enables fair reporting of potential tax liabilities and such that the taxpayer can fairly estimate what its tax exposure would be in respect of a transaction. And it also helps to reduce the incidence of double taxation that may arise where there are no such agreement, particularly if we have bilateral or multilateral APAs. It reduces the possibility of double taxation. APAs are binding on the taxpayer and also the tax authorities, provided that there are no changes in the terms of the agreement. Can we go to the next slide, please? And now, APAs are very useful. Like we have said, it provides certainty. And also, it helps in investment decisions, particularly where they are done in other countries or other jurisdictions. And it helps the investor to have an idea of what the future tax exposures will be. It also helps to mitigate the risk of possible very difficult TP audit, particularly where there are TP audits, and once APAs are there, it helps to mitigate against difficult audits. It also substantially reduces possibility of future double taxation. APAs are used to cover virtually every transaction: tangible, services, intangible, cost sharing, cost pooling, any of those arrangements. APAs could be negotiated. And very importantly, taxpayers participate actively in the process, which is very good. Whereas a map is majorly between the two relevant competent authorities of the relevant states. But in APA, the voice of the taxpayer is usually very loud and clear. We can go to the next one, please. Now, but we also see that in many developing countries, there are not many APAs. And why is this so? There are a number of reasons for that. One has to do with skills and experience. As such, many developing countries have phobia for negotiating APAs. There are issues of resources, which we include both human and financial, because APA could also take considerable length of time to negotiate and to conclude. Usefulness of APA sometimes may become diminished where there are no agreements at the end of the whole process. And also, sometimes taxpayers are very reluctant to provide information, particularly in developing countries where we have asymmetric information. So a lot of time we see that MNEs in developing countries are not usually very enthusiastic about providing information that will enable tax authorities to do APA. The issue of trust deficit is also there. There appears to be mutual mistrust between taxpayers and the tax authority, which goes both ways. And of course, there are issues of infrastructure, access to information, ability to cross-match information that are provided from other sources that will give the level of confidence that will enable tax authorities to go into APAs. With respect to COVID-19, the impact on TP, we have seen quite a number of responses from governments on COVID-19. There are a number of assistance programs, some monetary, some non-monetary, and this one way or the other has effect on comparabilities of comparables or reliability of comparables. There were issues of additional risk that probably are not considered in transfer pricing analysis. For example, hazard risk. That is the risk of contracting the infection, and how does it play out on other risks? For example, how does it affect the marketplace risk? How does it affect financial risk? How does it affect operational risk? How does it affect the ability of entities to meet up with contracts? So all of these are some of the complications that COVID-19 has brought into transfer pricing. Also, the issue of how do we allocate risk or cost. For example, there are some exceptional costs that businesses have to incur as a result of the pandemic. There are additional costs providing protective gears, providing hand washing equipment, providing face masks, and all of that. Now that the jab is out there, some organization may decide to provide immunization for its workforce. So all these costs that are not normal business costs, how do we account for them in our transfer pricing analysis? And of course, changes in the economic conditions also, which are not anticipated while negotiating APAs. How do we account for all of that going forward? So these are major issues that have been identified as a result of COVID-19. Part of it is also the economic conditions that are brought about. For example, temporary or dynamic changes that have taken place. The way talking about staff rotation that have been occasioned by the reason of COVID-19, sometimes may require employers hiring more temporary workers to fill in gaps and things like that. Movement restrictions, particularly, may make it difficult for collaboration between tax authorities during the outbreak. For example, if there are MAP processed or APA negotiations in process, they may be delayed. There could be suspension of domestic proceedings, for example, in Nigeria. For most part of last year, the courts were not sitting, and so which means that tax cases could not be had as a result of that. And of course, also providing for taxpayers to provide information where the critical staff are not in session. And these are some of the major impacts arising from COVID-19, and which has effect on transfer pricing. We can go on to the next one. Now, with respect to existing APAs, we also see that there are a lot of challenges arising as a result of COVID-19. For example, how do we re-examine agreed parameters to be sure that we can still go ahead and implement the APAs? For example, there may be drop in revenue or demand. How does it affect the elements that have been agreed in the APA? There's also the question of whether some APAs should even be terminated or should be revised or otherwise cancelled. And this is also as a result of different economic scenarios, market conditions that are coming into play as a result of the pandemic. What about issue of bilateral and multilateral APAs? Is it appropriate for the parties to make unilateral changes, or do we have to renegotiate on the bilateral or multilateral basis? So these are some of the impacts that may occur as a result of COVID-19 on existing APAs. Next slide, please. Now, the grand question is, what about changes to APAs that are under negotiation, or the challenges that are there or that are likely to arise? And that is issues of uncertainty in the environment. When the situations are uncertain, then it becomes very difficult to come to an agreement. Also, tax authorities may now require additional information which were not anticipated at the beginning of the negotiation. Otherwise, the attitude might be to say, let's adopt a wait and see until the events eventually plays out. Taxpayers and tax authorities may also be unwilling. They may become unwilling to conclude negotiations where they are not sure that the outcome will be a fair result. And finally, we can also see that there may not be that willingness for taxpayers to initiate new APAs. And I can speak from Nigeria's experience that since 2020, we have not received any request for APA, unlike previously when we have requests or inquiries as to how APAs could be started. Can we go on? And so then the real question then is there a need to renegotiate, particularly those the old ones or the ones that are nearing completion? And otherwise, if there's no need, then what do we do? Generally, where there's an agreement, unless there are material changes, it is fair that parties stick to the agreements that they have made. Otherwise, there will be no need to enter into those agreements in the first instance. The alternative, however, where there are doubts, is to look at possibility of granting short-term agreements that may cover a very limited period, probably 1 or 2 years, which will probably cover the time of the uncertainty until normalcy will return, or to possibly agree with all parties to renegotiate all the conditions that we require revision in the APA. Next slide, please. There could also be issues of government restrictions that may come as a result of MAP, and therefore consultation, revisions, cancellation, revocation of APAs will require a lot of consultation with the other parties and also collaboration and dialogue, so that everybody will have an agreement and it will not be a very bad breakup of agreement that could further affect relationship in the future. And of course, there could also be there will be need to have a lot of communication, particularly that we do not have freedom now to do physical meeting, and so there will be a lot of reliance on virtual meetings, just like we are having this webinar. There will be a lot need to do more of email exchanges and also using encrypted mails to send sensitive documents. Next slide, please. And so there could be a possible increase in TP disputes, and that is the conclusion from what we can see due to the uncertainties that pervade our system. It is expected that the issues of government assistance in jurisdictions, changes in economic circumstances, issues of wage subsidy grants, tax deduction, all of this that may bring uncertainty to the reliability of comparables would need to be considered as part of the new thing to take on board with respect of our APAs, even when discussing or negotiating MAPs to resolve existing duties. We need to be able to find a way to bring this into the elements that will be considered. Next slide, please. I think in conclusion, the COVID-19 brought a lot of problem to the whole world, not just to any section, not only developing countries, but it also brought opportunities. We can see a lot of opportunities to do business in a different way. We also see opportunities for a new line of businesses to open up, and also probably opportunity to improve the infrastructure in developing countries. And these opportunities are made possible by technology, which eventually has changed the way we transact business and carry out functions. And therefore, countries, including developing countries now, need to make a choice to adapt, particularly developing countries. We need to adapt our system and processes so that we are not left behind, either in the way we do transfer pricing analysis or negotiate APAs or our MAPs. I want to thank you very much for listening. Thank you, Josephine.
Thank you very much, Matthew. It was a great pleasure listening to you. I have enjoyed the presentation. Now we will move to John Hughes for some comments on the presentation. Thank you. Welcome, John.
My goodness. Thank you, Zoom, for reminding me that I was muted. So, Josephine, thank you. And Matthew, thank you very much for your presentation. It's a pleasure to be here with you. These issues that we're talking about today are of such importance, obviously, to taxpayers and to tax administrations. And I think one of the themes that you've heard throughout, of course, is from a tax administration perspective, there are so many uncertainties with what will be coming in the, from a competent authority perspective into our offices in the next couple of years. We know that 2020 was an extraordinary, obviously unprecedented year, and of course the previous panels have laid out all the areas of uncertainty, and Matthew has identified those that are going to be affecting us in the competent authority space. So, at this point, we are in a bit of a wait and see mode, but I do want to, convey some of the thinking that at least we in the IRS are doing about the current situation, reflecting upon the things that we're seeing now, and perhaps reflecting upon some of the things that we'll be seeing in the future. And so in doing so, I'm going to pick up on Matthew's kind of order of presentation. Again, Matthew did a very good job of giving us a comprehensive lay of the land and the various things that we consider in APAs from a tax administration perspective. I trust the audience is aware of the IRS's APA program. The IRS has been doing APAs since the early 1990s. Indeed, I'm quite sure that the U.S. was one of the first APA programs to be established, and obviously in the years since then, APAs have become truly a staple of the competent authority process, and that's with very good reason. Advanced pricing agreements do provide both taxpayers and tax administrations with tax certainty. A lot of times one hears today about taxpayers seeking tax certainty, and indeed the goal that tax administrations should rightly have of providing that tax certainty. But I think it's important from a tax administration's perspective to see APAs as indeed a tool, if you will, for managing one's transfer pricing portfolio, if you will. So, the variety of taxpayers that one sees within the tax administration, APAs can be a very effective tool for managing compliance, incentivizing and managing that compliance. I'll get to some of the challenges of running an APA program momentarily, but I do think that it's important to regard APAs not just as an accommodation or something that if you will, tax administrations would want to extend to taxpayers, just out of an interest in providing tax certainty to taxpayers, but also as being in the administration's own interest. you know, as again, the audience may be familiar with the IRS's APA program. We have a very large program. Right now, we have approximately 400 APAs in our live inventory, and that number holds pretty steady over time. We have many new APAs, many renewals. We certainly have more bilateral APAs than we do unilateral APAs, but unilateral APAs are also a significant part of our inventory. And we do have multilateral APAs. They are not as common as bilateral, and you know, for reasons that I think everyone can imagine, they do require substantial time and commitment of resources and just dedication from all the stakeholders, certainly the taxpayer as well as the 3 or more jurisdictions that are involved. So, you know, but the United States' commitment to APAs is, you know, I mean, that's apparent, but you know, let me be, if I may, honest with the audience here. APAs do require a substantial amount of time and resource. The development of a position for presentation to the other side takes time. If the issues are complex and material enough, then we will dedicate an economist to that team. Economists are you know, very valuable in many respects, but especially when the issues become substantial, then we want to make sure that we have dedicated that resource to the APA team. We realize that, you know, as we look across our competent authority counterparts, we realize that in the IRS, we do benefit from the dedication of those resources and the expertise that we can bring to bear. And that's, you know, we're very fortunate in that regard. And our senior leadership within our large business and international division sees, you know, the importance of the APA program and is willing to dedicate those resources to us. You know, so we realize that not all administrations have that kind of resource, and so I think that underscores, if you will, a philosophy of ours within the U.S. competent authority. Certainly, if I may, my personal philosophy of mine, you know, we view our competent authority counterparts as peers and as partners. We taxpayers are stakeholders, but it's not just necessary for the process to run efficiently, but it's important as a matter of respect for the treaty and respect for the mutual agreement article and the competent authority process, that taxpayers understand the need to treat both competent authorities or the multiple competent authorities, if it's a multilateral APA, on an equal footing. And so it's not at all uncommon for us as the U.S. competent authority to be, you know, nudging, cajoling, forcing, you know, even U.S. headquartered companies to make sure that they are providing the other competent authority with all the information that is needed in order to work the case. You know, that's just a fundamental part of the process. And I think that also speaks to another aspect of our experience with APAs and the competent authority process generally. The United States, of course, we are home to many multinational corporations. And so, if you will, we have a great deal of experience with cases, outbound cases, right, where the parent is in the U.S. and the subsidiary is in another country. We also then, though, are the home of many subsidiary companies, right, of foreign parented corporations. And so, you know, one of the things that I think it's important for all of our competent authority counterparts to understand is we see both sides. We see both the outbound and the inbound issues, and I think that's important because it gives us an empathy, if you will. Some of you've heard the theme of information asymmetry. I think it was Jose on the prior panel who talked about the difficulties that a tax administration of a subsidiary company that they may face in obtaining data relevant to their analysis that they properly need for their analysis, and the difficulties they may get or they may face in obtaining that data from the foreign parent corporation or from the foreign parent competent authority. We've faced that very difficulty. We've seen that information asymmetry, and so we very much appreciate the difficulty and challenge of that. And so we feel obliged, of course, to then make sure that we're not doing the same to our partner competent authorities in the outbound cases. If I may now kind of switch to some of the topics more specific to COVID-19 and whatnot, we are beginning to see with greater, I guess, momentum, we'll say, the number of taxpayers approaching us who have APAs that are in their final year of their term. For some of them, they may be ending. We have a number of taxpayers, say, who have APA terms that end March 31st of this year. So we're starting to see those taxpayers coming in. They are now taking a look at their 2020 results. They, with, in a sense, the benefit of all of 2020 having unfolded and able to assess perhaps the full extent of how COVID has impacted their operations. Some of the things that we're seeing, I think it's helpful for you all to understand. There are a good number of taxpayers who made out more or less fine in 2020. That's to say that perhaps there was some dip in their results, but I think it's safe to say that the fears that we may have all had in the spring of 2020 may not have materialized, at least to the extent that we had all feared. Obviously, very happy for that. Not just because it means fewer cases that we're going to have to review, but simply because that means that taxpayers were able to weather the storm of 2020. So that's good. All right, but we are seeing taxpayers come to us again, reflecting upon their 2020 results, and they're seeing, well, here we go. So some are coming to us and they are presenting their financial results, and they are pointing to say decreases in sales, increases in costs for perhaps clear COVID related reasons. And we are with those taxpayers very willing to hear them out, talk with them about their situation, about the commercial reasons that they are seeing the results that they have. I underscore these points of commercial reasons and whatnot, because there are some taxpayers who are coming to us now who are pointing to difficulties, low results and whatnot, or for reasons that are not borne out by kind of clear commercial reasons relating to COVID. They may also be coming to us asking that we bless, I'll say questionable interpretations of accounting standards. And I go back to some of the remarks made in the first panel. I think it was Mark who was talking about, the categorization or classification of certain expenses as extraordinary or not. Typically in our APAs, we require that the U.S. taxpayers use U.S. GAAP or U.S. accounting principles. And, at least in the past few years, those accounting principles have been quite stringent about what costs may be deemed extraordinary or not. And so if we step back and we think about this kind of situation, or the situations where taxpayers are coming to us asking for treatment and accommodation in light of difficulty in results, we do come back to some of the very things, and now I think I'm going to Manuel and whatnot. Various people have talked about the accurate delineation of the transaction. Back to first principles. What does the contract say? There are no contract speaks to all the risks that may unfold in the course of that term. Okay, so how are risks to be allocated according to the contract? And then, as the guidelines tell us to do, how do we look at the activities, the control, the decisions over how to mitigate risks, how to, take on or leave risks and whatnot? All of those principles very much come into play, and so we are exploring those with taxpayers. We will endeavor, undoubtedly, to alleviate double tax where we can. And we are working very well with our competent authority counterparts in order to do so. However, taxpayers need to know that that this is a situation where these first principles matter. And so if one side of a transaction has been allocated the risk and controls the risks in those relevant meanings of Chapter 1 of the guidelines, then, well, and especially if they have enjoyed the upside in prior years, then it does stand to reason. It stands to principle that the costs of 2020, to the extent that they've manifested themselves, then those need to be accounted for on that side as well. I see my time is just about up, and I guess in conclusion here, I guess again I want to underscore the point of empathy, if you will. The United States, yes, we're very experienced. We have a very large staff. We have a very experienced staff, and I, as director, am very lucky to have such a large experienced staff, and I appreciate all the efforts that they put into this. But I hope the audience understands that we do understand the concerns and the difficulties, the challenges, the questions that you all as tax administrations are facing. We share those. And, with the taxpayers, the concerns that they're bringing to your attention, they bring to our attention as well. And, we look forward to any opportunity that we have to be able to work together collaboratively as stakeholders in this very important and often challenging and difficult area. So, Josephine, thank you. Back to you.
Thank you, John. It was really nice listening to you from a very experienced perspective, from having dealt with these issues over a long time, and also the numbers that you deal with. So now we have heard from the policy side, we have heard from the revenue authorities as well, but the disputes normally have two sides. So Janine will come in to give us the perspective of the taxpayer, what this has meant for them, and what her take is on what has been presented so far. Janine, thank you for being here with us. Yeah. Welcome.
Thanks very much, Josephine. So, and thank you, first of all, for having been invited to participate in this wonderful webinar. I thank you to Matthew for a great presentation, and I very much appreciated John's comments as well. It never, quite frankly, ceases to amaze me just how much common ground there is between businesses as taxpayers and tax administration and policymakers. So it's early days for business as well. Many of the tax returns for 2020 are not yet filed. And our earlier speakers did speak about some of the challenges that businesses are facing because of COVID-19. I wanted to amplify those a little bit, really picking up John's point about paying attention to the commerciality of the impact of the pandemic. And so with this first slide, I wanted to do a bit of scene setting and talk about the impact on a business, and I'm using a manufacturer as the context for this. Obviously, as a manufacturer, the first thing that the business would face is disruption to its supply chains. And depending on what type of disruption that is, that might require immediately looking for alternative sourcing of raw materials or finished goods. Those alternative sources may come with additional costs. So it could be as simple as air freight, because you don't have a lot of time in many modern manufacturing systems to actually replace those raw materials that are missing. And that's because many globalized businesses, multinationals, really try to minimize their inventory levels. So they work on a just-in-time principle. They don't keep lots of stockpiles of inventory. And when you get a disruption like this, that's a risk that really crystallizes in terms of the additional costs then of making good. There were also the practical issues in a manufacturing environment of making sure that you are keeping workers safe, employees safe, that you're observing all the necessary hygiene, that you've got access to PPE, social distancing, or all of these things that I think we all understand very well now, given our experience fully a year on. For a manufacturer as well, it's not just the problem of accessing your raw materials, but it's making sure that you've actually got availability on shelf. And on-shelf availability can dramatically affect your level of profitability, because if a consumer still wants to purchase a product, but you haven't managed to get that product on a shelf, but a competitor has, then clearly you're going to see an impact in your sales line. And for businesses that are really impacted, there is going to be underutilization of assets and of workforce. So a lot of these then are fixed costs that you aren't able to recover. So that's going to affect the profitability. And the other observation I would make is that this doesn't happen in a proportionate way. So if, for example, I take our own business, we have quite a significant ice cream business. There's ice cream that we sell out of home. So when people are just out and about, recreation, maybe in a restaurant or a cafe, and they buy an ice cream, that's out of home. But we also sell ice cream in home. So we saw that our business on out of home was heavily impacted by the lockdowns that were imposed, and also the closure of restaurants. Whereas the in-home business started to grow as people offset that by doing more and eating at home. So that's just one illustration of, though, while you've got one business line, it may be impacted in very different ways. And to take that example a little bit further, the significance of that on a country by country basis is going to depend not only on how significant that aspect of your business is in a particular country, but it's also going to depend on how that country implemented its lockdowns, whether there were looser restrictions, whether there were very heavy ones. And for example, many countries, even though they imposed a lockdown, still allowed employees to go to work where it concerned the manufacture of food products. But not all countries did do that. So there's huge variation in terms of how countries responded to the pandemic, and therefore what impact it had on a business, even though you would think, well, this is one multinational and the business must be fairly homogenous. It's actually simply not the case. There's also the question of having people in the wrong place, if I can describe it that. So when some of the lockdowns happened, they happened very quickly. And so even if people wanted to return, maybe they were on vacation somewhere or maybe visiting family, they weren't necessarily able to get back to their normal place of working immediately. And so that raises questions from a transfer pricing perspective of, well, if these are very significant roles, what impact does that then have when you come to do the transfer pricing analysis? And then finally, other speakers have spoken about government support measures. And I just wanted to make the point that not all companies took advantage of these measures. So there are quite a number of multinationals who maybe were better placed because their sector wasn't so significantly impacted, that decided that for the public good, they were not going to take advantage of these support measures and leave them for other businesses who really had a greater need. So if I can go to the next slide, I mean, what this all says is, and other speakers have made the point, that documenting the facts is really critical. You've really got to understand the commercial context, so some of those commercial drivers that I just went through, but also then apply them to the fact pattern of the particular taxpayer. So you need to understand the business model context, what the specific impact to the business was of the lockdown or the supply chain disruption. And then all businesses don't just stand still. You know, that businesses actually are quite agile, and when there is a crisis, they can respond really quite quickly sometimes. So the agility of their response, understanding the dynamic of that, how did they respond, is also going to be important to get a proper understanding of the transfer pricing position. So for example, when it became more difficult to sell things through a store, in many countries, online sales increased in response. And so that type of channel shift is one example of ways in which a business might respond to the crisis and the challenge at hand. So all of these things taken together, what impact does it have on functions, assets, and risks? And I think it is useful to look at, well, how do third parties respond as well in these scenarios, so that you can benchmark not through the comparability analysis that some other speakers have spoken about, but just some real practical examples of how third parties also responded to the same unexpected environment that was they found themselves in. Other speakers have mentioned the importance of looking at results, and I do think it would be very helpful to look at, on a country basis, what changed in the profit and loss account for 2020 versus the prior years that were perhaps a bit more typical. And I think great care needs to be taken there to make sure that you are making a comparison to what would be a typical year. And then to also look at, well, what was the outturn of that actual result in 2020 versus what might have been forecast much earlier in the year before the extent of the pandemic was really fully envisaged and people could understand what they were facing. So if you like, the untouched forecast for 2020. And then I think understanding the total system profit is also useful. And this is particularly in the context of where you may have a limited risk distributor in a country and a regional principal. How is the system profit as a total going to be affected across those different participants in the value chain? And documentation of exactly when the travel restrictions were in place, or when they might have been imposed by the destination country, because there's obviously, if you want to travel, you've got to go from somewhere to somewhere, and so you need to it needs to be documented exactly what those travel restrictions were. So coming on then to sort of summarize all of this, I think the pandemic had an unprecedented global impact at a point in time when business has never been more globalized. And I think that really sort of underscores the scale of the challenge that is facing all of us, tax administrations and taxpayers alike. When businesses face crises like this, concerns about liquidity are uppermost in businesses' minds. So they want to make sure that they've got the financial resources to continue to be able to operate. And that means that they look at their customers, they look at their suppliers, they look at their employees through that lens of what do we need to do to make sure that our business continues to be viable, that we can make sure that where we have critical suppliers, they continue to be viable. And the same where we are very reliant on certain customers, what is it, looking at their needs to change to get through what are extraordinary circumstances and the challenges presented at this point in time. The business model, I think, can be tested in terms of the allocation of risks against third-party responses. And this is, as John says, the starting point is to look at the contract, to see where the allocation of risks lies, and then to test what happened in practice as the business responded to those risks. But as I've just mentioned, in the case of, a dependency on a critical supplier, there are plenty of examples where the contract may not be respected for very good reason, because that is the absolute appropriate arm's length response to the particular issue to get through the crisis. So I think they're, bringing it back to commercial reality and what the normal taxpayer would do in response to this type of business crisis, I think will allow you to evaluate the risks in the transfer pricing in a much more informed way. I do think that a pragmatic and flexible approach is going to be needed for 2020 when it comes to APAs. Obviously, it will depend on the scale of the impact in the particular business. It could be that the type of impact on the business was not that material, and so a revision could be made to an APA that's in existence. But where APAs are about to be negotiated, clearly for every business it's going to be different, whether the business was temporarily impacted by 2020 and will revert on a more normal course going forward, or whether the sector as a whole simply was devastated in 2020 and may take many more years to recover. So I think it's not going to be one size fits all on this, and a very practical approach is needed. And then finally, I just did want to comment on the merits of a BARPA versus MAP. From a taxpayer point of view, it's clearly much better to prevent a dispute than to have the potential for double taxation, despite MAP, because MAP, although it's an opportunity to avoid double taxation, it doesn't always result in the avoidance of double taxation because, for example, the competent authorities may finally not reach an agreement. So from that perspective, it's much more advantageous in terms of taxpayer certainty to think about entering into an APA rather than MAP. And then just some quick positives. Certainly, we have found that we've made much more accelerated use of technology for virtual meetings, including with tax authorities, including with audits that were ongoing. And quite honestly, sometimes they've been a lot more flexible. It's taken less time to actually travel to a meeting, and we've been able to make better use of time, so they've been more productive. That applies equally to virtual audits, functional interviews and site visits. there is a big opportunity, I think, to address and update processes. So and adopting electronic signatures and electronic filing of tax returns, it would be we've seen improvements in this area as a result of the pandemic, and this is something we really should hold on to and do more of. So with that, I'll pass back to you, Josephine.
Thank you, Janine. That was a very interesting take. And thank you to all the panelists for this session, for a very informative, very balanced presentation. And we have a bit of time, so we'll just take one question from this session. First, we had a comment where the presenter, Marcos Valdo, said, great presentation, Matthew. However, lack of capacity is still a big problem for tax administration of developing countries. And the pandemic has worsened this aspect because we need more skills to deal with a more complex and unstable scenario. That was just the take on the presentation. So the question that we have is addressed to John, and it's from Luis Maria Mendez, Luis asked, hi, John, I enjoyed your presentation. I wonder whether the ADT could be modified due to the pandemic, e.g. changes in the risk control chain by charging inevitable risks on subsidiaries. Thank you.
Sure. Let's see, ADT. I don't know that I spoke about it. I'll talk about what I take to be the question. We are certainly on the lookout for the potential that some groups may recast or seek to review and perhaps modify the transfer pricing arrangement that they have had in place for a given subsidiary, let's say, and perhaps recast them as a risk-taking entity or whatnot. You know, we are willing to have discussions about whether you know, such a restructuring is appropriate. But we would be very careful in walking through the steps of restructuring to make sure that that restructuring had been properly done. And that is to say that there had been proper compensation to the entity that may now be taking on risk or whatnot, such that when they do assume that new profile, that they are now, in a sense, you know, properly at the starting line, I guess we'll say. I hope that was responsive to the question. Again, I'm not exactly sure what was meant by ADT. Forgive me.
Thank you, John. The participant, if they have further questions, I'm sure will send a follow-up.
Yes,
so
thank you.
We are now moving to the fourth session, where I'd like to request all the panelists to have their cameras on, if you would please, so that we know who is still with us to address the questions. So all panelists, kindly. I see Matthew, Janine, Carlos, Jose, Tove. Jan, are you still with us? Thank you, Jan. You're still muted though. I did not hear you. Yeah, so now we can move to the questions. I see we have the panelists with us. So the first question will be from session 1. The question was asked by Maria Grosten from Uruguay. So from my point of view, in the case of Maquiladora, the cost has to be assumed by the principal. What are your views? This was addressed to Carlos.
Can you repeat again, please? Sorry.
Marcia from Uruguay wanted to know, in the case of the Maquiladora, the cost has to be assumed by the principal. What are your views?
Yeah, well, I think the answer should not be black and white. I mean, every situation has to be delineated. I think we have spoken a lot of this. And even maquiladora entities, they have a compromise, a legal compromise to produce a number of items. And when the crisis came, they wouldn't be able to commit to their compromise. So to her question, I would just try to commit how third parties would behave. A lot of entities in Mexico renegotiated their contracts. A lot of companies divided the losses. And what I want to pose here only on the table is how do these companies would cope with non-recurring expenses? In the case of Maquila, they had fixed costs when the plants were shut down. So the question was if these fixed costs that they had should be assumed by the principal entity or with a margin like aligned with the transfer pricing policy, where they would charge a margin, or this would only be like a reimbursement of these expenses. So I think it's not like a really easy question. And my perspective is that even a low risk entity has risk, and even more when these economic elements are unexpected and are significant.
Josephine, may I come in on this as well? Is that all right?
Yeah, sure, John. That's all right.
Okay. Yeah, I know I wasn't on panel one, but the topic of maquiladoras is an important one. I think it's only appropriate that I should be following my good friend Carlos, with whom our teams had done a significant amount of work on maquiladoras. As many may know, the United States and Mexico have had an arrangement concerning the pricing of the services provided by maquiladoras. That arrangement has been in effect for some years, and announced, I think it was last November or so, we had renewed that agreement, and indeed we are continuing discussions with Mexico now about rolling that forward, but accounting for the events of 2020. And just in line with what Carlos was saying, we are we are cognizant of the need to take into account the fact that on the one hand, be it the United States principle, in relation to the maquiladora, it may often be the case that there are costs from COVID that need to be borne by the U.S. parent. However, the fact that a maquiladora is, as Carlos points out, there are ways in which it is similar to a contract manufacturing entity, then there may be some cost that would be borne at arm's length by such an entity. We are, it's a difficult question, certainly, but it's one that we are working very closely with our competent authority counterparts with SAT to work through, and with all these considerations in mind, to find a balanced, fair solution for the tax administrations and taxpayers alike.
Thank you, John. That was most helpful. So we have another question from session 2 from Jose Monsalva. A couple of panelists have mentioned the use of safe harbors so far. Considering the additional complexity due to the pandemic and specific issues of taxpayers and industries, do you have any additional recommendations for its design and implementation? This goes to Jose and Carlos. What you have to say about the issue of safe harbors?
I think I already mentioned that safe harbors should be considered, at least the option is not that always are suitable. we need to take into account the possibility of course, of double taxation, but also that could be arranged as the very good example of the maquiladoras between Mexico and United States could be. That might be the I don't know, best scenario for a simplified measure or a safe harbor. I think that for our countries, we should take that option very seriously into consideration, and now better, more than before. Thank you.
Thank you, Jose. Carlos, do you have anything to add?
Yeah, I just want to add regarding safe harbors, because I've been studying the case, and in Mexico we have the safe harbors, that a safe harbor is not only like a fixed margin. A safe harbor can be in a different many ways. I mean, it can be also the so-called six method. The Argentinian six method could be a safe harbor as well. I mean, this is only like a mechanism to follow a pattern. So it can also be to follow an economic variable as well. So I think safe harbors should be used mostly in countries where they cannot manage the system correctly, and try to be as close to arm's length as possible in critical industries that they want to preserve and take care of. Of course, if you ask me this in these times of crisis, it is difficult. I mean, no one could think about how volatile the market is right now. But I think if you take account on the difficulties on transfer pricing, safe harbor is a clear answer in really specific cases where it would be relevant to utilize it and to be efficient as tax administration.
Thank you, Carlos. Thank you, Jose. So the next question is addressed to Jose and Matthew from Sadu Abubakar Abdullahi. How do developing countries overcome the challenges of inadequate comparables? Matthew?
Thank you very much, Josephine, and thanks, colleague, for the question. The issue of comparable, I think, is more specific to the relevant transaction. Probably what the person asking the question wants to look at is the availability of specific comparables that are relevant to specific transactions. And the answer to that is in the regions where we have comparables, how did they get this? They got comparables because they maintained statistics. They enabled entities that are not controlled to provide financial account information. It is important, therefore, that developing countries must also have laws that requires private entities to provide audited account information from where detailed transactional costing can be pulled into databases for the purposes of benchmarking. This is very, very important. Otherwise, the current state where comparables from different jurisdictions have to be used cannot be avoided. So the starting point is our company laws that must make it possible for database operators in developing countries to have access to information of uncontrolled transactions, and then to be able to structure and organize them in such a way as could be useful for transfer pricing benchmarking analysis. I think that would be my comment, Josephine.
Thank you, Michael. Thank you, Matthew. I don't know. We have another question. This question is for Mark. Mark, is there a suggestion in the very interesting presentations that subsidiaries have lower risk than independent entities since they are too important to the group to fail?
Well, that was a view that Canada expressed a long time ago in one of their Supreme Court cases, and I don't buy into it, and I don't think most people buy into it. And particularly individuals at the subsidiary level would not buy into it. I don't see how you can say that their risk profile is going to be any different than anybody else's. Going back to what John Hughes said, and to me, the most important document is your contract, which establishes the legal responsibilities between the parties. And John is absolutely right. There's no way a contract can express every single risk, but there are primary risks and there are ancillary risks. And I just don't see how one can say just because you're a subsidiary of a parent company, you're going to be any different than an independent company. It's how that company is configured.
Thank you. Thank you, Mark. So the next question would be for Tove and Yang. Would you kindly comment on transfer pricing being related and used very much as a mechanism for illicit financial flows? What are your thoughts on this, Tove and Yang? Thank you.
Is Jan here? Does she want to go first or should I?
No problem, you go.
Okay, all right, for
Lucky
sure.
you.
Oh, I think this is a really good question. And this is something that we're always happy to talk about. Of course, illicit financial flows is a broad basket of issues that includes illegal activities, and it's generally difficult to estimate, but it's very clear in the illicit financial flows discussion that large-scale corporate tax avoidance by multinational corporations is a very, very substantial part of the problem. There are some estimates saying it's by far the largest part of the problem, but of course, the first problem we have is that due to lack of transparency, these estimates are exactly that, estimates. But generally, the discussion about corporate tax avoidance, there's generally agreement that we're talking about hundreds of billions of dollars in lost tax income. Of course, we're in a special period and a special situation now, but we will again, once we get back to more normal days, of course, this problem will not have gone away. And even for the extremely profitable corporations that we're seeing now, of course, it's a huge concern that the corporations are making very large profits and not paying their share of tax. It's a problem for the tax administrations and countries that there's a lack of money, but it's also a problem in terms of the unfair competition for small and medium enterprises that can't use these international transfer pricing rules to lower their tax bills. And in that context, it's of course also important to discuss what do we do about illicit flows. One of the problems with the transfer pricing system is that it very much bears the mark of having been developed. It started over 100 years ago, but the fact that it comes very much from the world of OECD, and we have had developed countries and very much the home countries of multinational corporations play a very big role when these rules were written. And we can see that especially the mark of least developed countries is absent, because we see in other United Nations negotiations that one of the concerns the least developed countries always raise is whether it's going to be administrable, whether it's simple enough, whether it's clear enough. And this is also why we, when we talk about needing a new global tax system, are very keen on ensuring that least developed countries are really at the table and participate effectively, so that the question becomes how to design a system that works for them rather than capacity building them afterwards to try and see if somehow a system that they didn't influence can be applied. But of course, I mean, right now in the inclusive framework, we have the situation that 2/3 of the least developed countries are not members of the inclusive framework. And there are different reasons for that. I mean, they have decided not to join for different reasons. But the thing with the United Nations is that everyone is at the table. Everyone participates on an equal footing. And the United Nations was established to negotiate international agreements to solve global problems. So this is why for us, the UN is an extremely important forum to discuss this. The UN has committed to tackling illicit flows, and there's no way we can do that without looking at this problem of corporate tax avoidance. And I think the complexities we've seen today is such a core part of the problem. Another part is, as I mentioned, also the fairness in the system as to whether the home countries of multinationals or the source countries get the taxing rights. But these are all political issues for governments to start negotiating and getting some rules that work. The rules are very bad for least developed countries, but they're actually not really working effectively anywhere in the world. So in our view, all countries have a strong interest in getting to work on this problem.
Thank you, Tove. Jan, any comments to add?
Well, I think it was definitely a wise decision to have Tove to go first, because she obviously had a better knowledge on this topic than I do. I don't think I have much to add on top of what she said.
Thank you. Janine, there's a question for you. Marcos Valdao from Brazil wants to know how to deal with differences inside the countries, which may spread out to global operations. So he gives the example of Texas states in the US who adopted a lighter or riskier approach to deal with the pandemic, whilst other states in the US decided to lock down for a long period of time. Issue of consolidation at local, state, country, global basis. So he wants to see if there's different situations inside a country. How do you go about it?
Yeah, I think there can be differences within a country. So not just the states within the United States taking different approaches to lockdown, but also states within different areas of a large country like India or indeed Brazil. And that's a reflection of the fact that when you're in a large country, the effects of the pandemic may be regionalized and basically not the same in all parts of the country at the same time. So effectively, I think that state issue becomes, it's a microcosm of what you are looking at a country level. And I think this is part of the fact pattern that you need to analyze in coming up with, you know, what is the commercial reality of the impact of COVID on your particular business with your particular facts.
Thank you. Thank you for your view, Janine. So we have one question here from Manuel. Some countries do not have a clear definition of what should be understood as a limited risk entity. And in the practice, there are a bunch of companies arguing limited functionality and risks, but in practice, deploying significant functions. It will be a good idea to clarify the concept and even provide examples complementing the OECD COVID guidelines. So Manuel, your take on this, and also feel free to comment on any of the issues raised from an OECD perspective. Manuel, over to you.
Yeah, thank you, Josephina. Thank you for the question. I think on that point, I would like to echo what John and Carlos said before. It's clear that the OECD transfer pricing guidelines do not contain a definition of low risk arrangement in general. And I think that trying to provide a definition for that would be almost like an unfeasible task, because the variation of agreements you can find in practice is just too wide. But that doesn't mean that we have no guidance or not proposed solution for that. I think the key point there is just going beyond the label of the arrangement, and first of all, understanding based on the contract, and then afterwards in the behavior of the parties, what are the risks assumed by the so-called low-risk distributor, low-risk manufacturer in those cases, and then making the link in the case that, in case we are analyzing the effect of the COVID-19 pandemic, how the pandemic has affected or impacted those particular risks that are allocated under the meaning of chapter 1 to that particular entity. And then is when you can work out, the consequences in order to price the transaction.
Thank you. Thank you, Manuel. And on the other issues, did you have any comments on the other issues raised?
Not really. I think all the replies have been quite thorough. I would also like maybe picking up on one of the comments from Janine on the last question about those differences in terms of like how, because I think it's not a question only limited to different regions within the same country adopting different measures or different strategies to tackle the pandemic, but it's actually a situation you can find across different countries adopting different strategies. And I think that's also highlighted in the guidance when we are talking about the relevance in that particular case of the geographical feature when you look for comparables. I think there is also a question in the chat, very, very similar to that one. So I think that's important in that respect to make sure that the relevant, comparability features that you're looking at are singled out and considered in the analysis. But also, I think it's important to understand in the current situation, and I think that's something also positive in the current guidance. You have to be flexible enough to understand the current situation, and in some instances, you might need to relax some of the comparability criterion that you're looking at in order to make sure that you are capturing the right ones with the right comparables.
Thank you. Thank you, Manuel.
Josephine,
yes.
do you mind if I just, I think it's very important to repeat something Manuel just said. Labels are not helpful. Labels are not helpful. I know anyone who has been doing transfer pricing analyses over time, labels are shorthand, limited risk, no risk. Even contract manufacturing is a label that is often used, and it may be okay if it is understood that that label refers to a fact pattern where the contract allocates risks in a certain way. There is a sort of control or function that is performed. Again, we see common fact patterns. We see many fact patterns that are quite similar, and so it's okay if we're talking about those fact patterns when we use those labels. Unfortunately, what we find, and I think we share this experience with many tax administrations, is that labels are used, but they are not carefully used. So I want to underscore that the guidelines very specifically do not use those terms, those labels, for that reason. And I guess as a last point on this, I want to note the difficulty that we, the U.S. Tax Administration, the U.S. Competent Authority, we face in, if you will, the characterization of an entity. Again, it goes to the label issue. Is it a low? Is it a high? Is it a medium risk? Whatever it might be. And one of the things that we are exploring and certainly trying to put time and analysis into is looking at not just, if you will, qualitative measures of comparability, but quantitative measures. So looking at what are the factors that drive profits for independent companies. So looking at asset intensity, if you will, and functional intensity measured by in quantitative, objective ways. We think that may be a very helpful perspective on what is a very long-standing and very difficult question of characterizing the entity, which of course precedes what is then the profit that is appropriate for that entity given that characterization. So it's complex, but we found it helpful to break things down into more and more basic units like that.
Hey, John, it's Mark. I just want to add to that, and you're very well familiar with the Frank Lyons case. Just because it says it's a lease doesn't mean it's a lease. And I echo your comment. To me, the most important document anybody can prepare is not necessarily your transfer pricing study, it's your contract. Because your contract establishes the legal responsibilities between the parties. And if it's not there, then you're missing something in your transfer pricing study. And oftentimes I get cases where I don't see a linkage between the two. And that's really important.
Thank you for your take, Mark. We are running out of time, but I think there's one very important comment I'd like to get from Jan. Briefly, how to deal with the issue of the use of foreign comparables, considering that some regions of countries may have granted government aid and others have not. How is it that countries should deal with it? Jan, if we could get your brief comment on this, that'd be great.
So the question was how to deal with government aid when you are using foreign comparables.
Yes, where in your situation you did not receive the government aid, so now there's foreign comparables where foreign aid may have been, government aid may have been received. What's your take?
Well, actually, I haven't done a thorough research on government aid, but my initial thought is that you may need to do some adjustment depending on the specific facts and circumstances of your specific transactions.
Okay. Thank you very much.
From session 2, do we have a government aid section? No.
It was mentioned briefly, but thank you. Now we are really pushing it on time. So I would thank you for your time and for answering the question as well. And thank you to the other panelists for staying to the very end to help us navigate through some of these questions. Now I'll pass the floor over to Caroline, the Chief of the International Tax Branch, for her comments. Thank you. Caroline.
Thank you so much, Josephine. I'll be very brief. I want to thank all the participants and expert panelists and colleagues for being with us here today. Thank you, Michael, for your leadership, and Michael and Josephine, both of you, for moderating this morning. I want to encourage everybody, please complete the feedback survey. This will really help DESA to learn and improve our capacity building work and also to ensure it's demand driven. My colleagues have enabled the chat now, so I hope you can see there the link to the survey in SurveyMonkey. If not, or in case you're watching on YouTube, we're also going to send it to everyone by email. Please take a few minutes and fill that out. Before I hand the floor over to Michael to officially close our webinar for today, a few very quick highlights what's to come. The 3rd edition of the UN Practical Manual on Transfer Pricing. It should be coming out in late April during the 22nd session of the UN Committee of Experts on International Cooperation and Tax Matters. We hope to have it available in electronic format in English as well as French and Spanish. There is our UN online course, which is being updated in line with the 3rd edition. We also hope to make it more accessible and even a bit interactive. We are going to convene with our partners, global and regional workshops based on the manual, and of course, specific transfer pricing issues of relevance for developing countries we continue to discuss through workshops and webinars like this. And just a quick mention, also mutual agreement procedure comes up today. We have available an online course on that in English now, soon also in French, and we'll be resuming MAP workshops in the 2nd half of this year. So many thanks again to you all, and over to you, please, Michael.
Thank you, Carolyn. Of course, the big unanswered question was, when does Mark get to play that guitar? But we'll leave that for another webinar in future, Mark. You can continue to practice. We heard him riff off on transfer pricing though too. So I wanted to also thank the panelists and the participants. It was a great group of people and a great group of questions. But I wanted to particularly thank the Secretariat in no order of magnitude of contribution. I wanted to thank Gabriella and Irving, Sean, Sheila, Josephine, Fareed, Ilka, Cecilia, Maria Fernanda, and Mayank. It just shows you how many people are involved in a few hours of this sort of a webinar. I also wanted to particularly thank Carolyn and Naveed for their support for this webinar series. And the only thing I would add before closing is we do have another webinar on the tax transfer pricing aspects of financial transactions, a very important issue in the OECD and in the UN work. And that will be on the 25th of March, starting at 8 a.m. So tune in for that. And in the meantime, thank you very much. And we will see you next time. Thank you. Goodbye.
Thank you so much. Stay well. Safe.
Goodbye.